Good morning, ladies and gentlemen. If you'll take seats, we're about to start. Okay. Let, let me wait till Jen 4 is back in the room before we
She's over in the corner.
tamper.
Right now.
Good. Jen, the question has been asked if we can move this camera monitor. Okay, the time is 9:33, and I'm going to convene this working meeting of the Commission on Worldwide Combined Reporting for Unitary Business under the Business Profits Tax. I want to thank everybody for being flexible. There was quite a bit of juggling and logistics to line this full day up, but I'm extremely pleased and want to give some praise and appreciation to Jen 4, who I think has been a terrific communicator, and everybody who's here as a guest, I'm sure, would agree with that. We have scheduled a half hour for each group, and I'm confident that that will allow for a presentation as you've planned, and then a good, robust round of questioning. And we'll take the questions one at a time around the circle. We do have two other members who I'm hoping will join us, and but we're going to proceed. This is being live streamed, so it will be recorded and available for anyone who wants to go back and view any part of it on YouTube, on the New Hampshire House channel. Also, a number of our guests are coming to us remotely, so we have a video hookup as well. And I think we've got everything dialed in as far as the technology to go smoothly. Because we have a whole array of guests who maybe don't know who exactly is sitting up here on the dais, I'd like to just quickly have each of us introduce himself, starting over here with Keen Wong.
Good morning. My name is Keen Ming Wong, Tax Policy Counsel at the Department of Revenue Administration. I am the designee for the Commissioner of the Department.
I'm Kevin Kennedy.
I'm Kevin Kennedy. I'm a certified public accountant here in New Hampshire. I was asked to be on this commission by the Business and Industry Association.
I'm Matt Foley, also a certified public accountant, and I'm here on behalf of New Hampshire Society of CPAs.
I am Representative Tom Schamberg, who has had all of you come here to spend your money in New Hampshire this weekend. Thank you very much.
And I'm Representative Walter Spilsbury, Sullivan County District 3, representing Charlestown, Unity, and Newport. I go by Terry. And we have two other legislator representatives who I hope will be able to join us, and that's Representative Ulrey and Senator Murphy. So with the introductions out of the way, our first panel, Tom Opel, O2 Strategies, LLC. And Tom is joined by Dan Collins, founder and owner of Dan Collins Painting Specialist and a selectman of Canaan. And Peter Garr, formerly of the Department of Revenue Service, who tells me his retirement project is primarily chopping wood. You can see how fit he is. Gentlemen, welcome.
Thank you, Mr. Chairman. So, Chairman, goes off by itself. Thank you for the opportunity to testify before you today in support of New Hampshire adopting worldwide combined reporting and ending the water's edge provision And as I say in the legislature, I'd like to associate myself with the chairman's comments about Jennifer Four. She's been fabulous. So thank you to Jennifer. I am Thomas Opel, president of O2 Strategies, a strategic consulting firm based in Canaan, New Hampshire, and a small business person myself. I represent today the Coalition for a Prosperous America, which is a nonprofit organization representing the interests of 4.1 million households across the political spectrum and economic sectors, working together for a new and positive U.S. trade policy that delivers prosperity and security to America, its citizens, farms, factories, and working people. And as the chairman noted, with me today are Dan Collins, an independent contractor from the Upper Valley of New Hampshire, and Pete Garr, who worked on business tax issues for the Department of Revenue Administration in the 1980s and 1990s, each of whom will speak after me. In the 1999 Caterpillar decision, the New Hampshire Supreme Court spotted the basic issue facing this commission today when it wrote, and I quote, "We point out that the water's edge method was adopted for the benefit of foreign businesses." And the very next sentence in that decision makes it clear that ending water's edge and adopting worldwide combined reporting is hardly unprecedented. The court's decision noted that, and again I quote, "Prior to 1986, New Hampshire utilized worldwide combined reporting." So the fundamental question this commission should ask itself is why New Hampshire businesses, contractors, store owners, craft breweries, or any other domestic company should be treated differently when it comes to their business tax liability compared to foreign enterprises. Obviously, we welcome all business to the state, whether domestic or foreign. But why should New Hampshire's business tax structure privilege foreign companies? Domestic companies employ more than 9 out of 10 Granite Staters, and that's using Global Business Alliance's own figures. So why should those 9 out of 10 employees and the owners of those companies be forced to operate at an economic disadvantage? And now that New Hampshire has moved to a single sales factor in determining business tax liability, it is very likely that the competitive disadvantage for domestic businesses for those mom and pop stores could become worse. Multinationals, as you know, have the capacity, the global operations, and the financial incentives to use accounting techniques, paper transactions, and other tactics, all perfectly legal, to shift profits to lower tax jurisdictions overseas. Water's Edge provisions obscure the full picture of their activities in New Hampshire from DRA because companies are not required to account for their operations outside the U.S. beyond the water's edge. As I said, these techniques are illegal, but they're anti-competitive and create a two-tier tax system that disadvantages homegrown businesses whose activities are limited to the New Hampshire and the U.S. Domestic businesses do not share the accounting capacity or overseas resources. As a result, these companies pay more than their fair share to support state operations funded by business taxes, or the state is shortchanged of revenue in a taxation system a level playing field would provide. Or finally, and this is the most likely outcome, we get a little bit of each bad outcome. And frankly, that's already happening. A joint January 2019 study by the American Sustainable Business Council, U.S. PIRG, and the Institute on Taxation and Economic Policy approximated the cost of multinational profit shifting as potentially accounting for $177 million in lost revenue annually just to the state of New Hampshire. This is revenue that could be used to relieve taxpayers either through direct tax cuts or by increasing aid to cities and towns to relieve property taxes or to provide other services such as support for public schools. With worldwide reporting, companies must do for their entire enterprise without regard to borders. This is what they do now for operations in every state in the U.S., and obviously any well-run business is doing this in every jurisdiction across the globe, although they're not sharing this data with New Hampshire, or at least they don't have to. Without worldwide combined reporting, New Hampshire-based businesses and the overwhelming number of Granite State workers they employ operate at a significant competitive disadvantage. And those are the companies who employ the vast majority of workers and companies who are committed to their communities and are critical contributors to the economic health and quality of life in our state. Dan Collins, who's run his own business for nearly 30 years, can speak to that impact and Pete Garr can explain how adopting worldwide combined reporting and ending water's edge, rather than being some novel or even radical scheme, will simply return New Hampshire businesses to the structure that existed prior to 1986. And so I'll give Dan an opportunity.
Good morning, everyone. Thank you for having me. As Thomas said, my name is Dan Collins. I am a 50-year-old self-employed residential painting contractor based in the Upper Valley here in New Hampshire. I sit before you today as a representative of small business owners. I've been a house painter full-time since I was in my mid-teens. By the age of 18, I was promoted to job site foreman, and that's when I realized that my career was going to be as a tradesman. At 24, I started working for myself. I've spent the last 26 years building a small business here in the Granite State. In that time, I've had upwards of 100 people work with me and beside me. I have built a home. I've raised a family. I've sent my daughter to college, and I've taught my son a trade. And for all of those 26 years, I've always paid my taxes. As a locally based small business, I've never been afforded the opportunity to shift my profits elsewhere to reduce my tax bill. That puts me at an economic disadvantage with foreign companies and multinationals that can take advantage of those kinds of accounting techniques. In our local municipality, I'm fortunate enough to sit on the select board. I serve on the planning board, a preservation committee, as well as several subcommittees, such as updating our master plan for economic growth and exploring options for a community center. I have also, as a select board representative, had the opportunity to serve on our budget committee. As a public official, I have both the honor and the burden of setting a local tax rate. I feel it is my responsibility as an elected official to work as hard as I can to keep all residents of our community on the same playing field. We have a level playing field in regard to property taxes. I would suggest we need a level playing field with regard to business tax as well. With a potential revenue loss of $177 million per year in the state of New Hampshire, I'm sure there are many municipalities in the Granite State that would benefit from revenue that is now being shifted elsewhere. I would ask this commission to report favorably to the legislature on ending water's edge and adopting worldwide combined reporting as the right step to create that level playing field. I thank you for your consideration this morning, and I appreciate the opportunity to sit before you today.
Good morning. My name is Peter Garr. I submitted the only amicus brief in the Caterpillar case. My amicus was over 30 pages. My testimony today is 6.5 pages long. I trust I will be afforded the time to read it to the commission. I was a business profits tax auditor with the Department of Revenue from 1980 to 1997. During that time, I traveled around the country to the headquarters of corporations that had operations in New Hampshire. Most of the corporations that I visited were multi-form, with a parent corporation and any number of subsidiaries operating in the U.S. and foreign countries. When I started in 1980, the audits were conducted on separate accounting, separate entity tax returns. For example, if the corporation that had operations in New Hampshire had a subsidiary, I audited only that subsidiary, as if it was a standalone corporation with no connections to related subsidiaries or the parent corporation. In these audits, few adjustments were made to the tax base. Most of the audit adjustments concerned the apportionment formula, the percent of sales, payroll, and real property in New Hampshire to total sales, payroll, and real property. Then the law changed in 1981 that allowed the department or corporations to employ the Unitary combined method. Of course, corporations that benefited filed unitary tax returns to pay lesser amounts of business profits tax. However, it was only upon audits that combined corporations paid more business profits tax under the unitary method. It should be noted that New Hampshire adopted the unitary worldwide combined method before it had been tested in a lawsuit. That lawsuit, Container Corp v. California, occurred in 1983. The purpose of the unitary combined method was to counteract the profit shifting that occurs between corporate members of a group of corporations controlled by a parent corporation. Intercompany transactions occur at prices determined by internal corporate accounting departments and international accounting firms. It's referred to as transfer pricing. The Big Four worldwide accounting firms are based in Britain, and tax avoidance is their specialty. A good example of profit shifting transfer pricing within the United States is Home Depot, which formed a subsidiary in the state of Delaware. It was revealed in an Arizona lawsuit that the Delaware subsidiary had just 4 employees, but reported profits of about $4.7 billion over 3 years, compared to $3.8 billion over the same period for Home Depot, the parent corporation. Profit shifting like this was and is a huge loss for separate accounting, separate entity states that utilize the arm's length principle, where intercompany transactions are supposed to be the same as between unrelated companies. After New Hampshire adopted the unitary business principle in 1981, it was the policy of Lloyd Price, the DRA commissioner, that we would not employ unitary combined reporting if the subsidiary was owned by a foreign parent. As a result of this policy, foreign-owned corporations were allowed to continue to file separate accounting, separate entity business profits tax returns. I thought that this policy was wrong. The letterhead of the Department of Revenue is the old man in the mountains surrounded by the words equity for all, treating U.S. subsidiaries owned by foreign parents one way on a separate entity basis, and U.S. subsidiaries owned by U.S. parents another way on a worldwide basis, was and is not equity for all. It does not ring true. In 1994, the U.S. Supreme Court in the Barclays Bank decision found that it was constitutional for a state to employ the unitary worldwide method with a foreign parent. The vote was 7-2 in favor of California. In the companion case with a U.S. parent, Colgate-Palmolive, the vote was 9-0. New Hampshire Attorney General at that time, Jeffrey Howard, joined an amicus with other states in support of the worldwide method. Also filing an amicus in support were United States Senators Byron Dorgan, Ted Stevens, Frank Murkowski, Judd Gregg, and Robert Smith. I just realized I missed a page, so I have to back up a little bit. I apologize. Regarding Home Depot, if Home Depot was a foreign parent and had a similar subsidiary in Bermuda or Luxembourg, most likely no profits or diminished profits would be reported to and taxable by Uncle Sam or any state. There are a number of documentaries that explain how multinational corporations avoid income taxes by shifting profits to tax havens. I recommend watching 2. The Town That Took on the Taxman, a British production, and The Tax-Free Tour, a Dutch production. Both are available free on YouTube, and it's best to watch with closed captions on. I do not know why the business profits tax law was changed in 1981, but I suspect it was due to the U.S. Supreme Court's 1980 Mobil Oil v. Vermont and Exxon v. Wisconsin decisions. New Hampshire Attorney General Tom Rath joined other states in an amicus brief that supported both Vermont and Wisconsin. If you haven't read these decisions, I encourage you to do so. Both cases concerned separate entity tax returns filed by Mobil and Exxon. Although Mobil and Exxon were very profitable for the years in question, Mobil reported 0 separate entity profits for 2 of the 3 years, and Exxon reported no separate entity profits for all 4 of the years in question. In both cases, the Vermont and Wisconsin Department of Revenue employed the unitary business principle, which the court stated was the linchpin of apportionability. Both states won their case against these oil companies that had made hundreds of millions in corporate profits. Excuse me. Vermont did not adopt unitary combination until many years later, but they did state their reason, which was described in a well-written statement of intent, which said in part, Vermont's separate accounting system is inadequate to measure the income of a corporation with non-Vermont affiliates and creates tax disadvantages for Vermont corporations which compete with multi-state and multinational corporations doing business in Vermont. It is the intent of the General Assembly in adopting a unitary combined reporting system to put all corporations doing business in Vermont on an equal income tax footing. However, for some unknown reason,
Mr. Guerra,
Yes?
if I can please interrupt. We have your written comments, and I see they are extensive, and the time that it's taking to read them in full is eating up the time that that your panel has. So I'm not going to stop it at exactly 10 o'clock, but I wonder if you can summarize, allow us to read the comments in detail, which we will do, and that will leave some time for questions of the panel.
Excuse me, Mr. Garrett. Mr. Chairman, we started at 9:36 with Mr. Opel. when he
Yes,
first
that's why I
started, so
intend to be lenient on the time.
Thank you, sir.
But I do think that reading the entire thing will not serve you the best.
I'll try my best. In 1983, the U.S. Supreme Court decided the Container Corporation case, which concerned employment of the unitary business principle across a group of related corporations. Container was a U.S.-based parent with both domestic and foreign subsidiaries. This was the first time that the court approved unitary combined reporting on a worldwide basis. Unfortunately, the court did not address unitary worldwide combined reporting with a foreign parent with U.S. operations. The New Hampshire Attorney General at that time, Gregory Smith, joined with other states in an amicus brief in support of California and worldwide combined reporting. Foreign corporations, foreign business associations, and foreign governments filed amicus briefs in opposition. Foreign objections and a lawsuit concerning a U.S.-based multinational corporation. I would like to read 2 short sections from the New Hampshire AG's amicus in the Barclays Bank case. Quote, to believe that multinational corporations do not maintain an advantage over independent corporations operating within a similar business sphere is to ignore the economic and political strength of the multinational giants by attempting to treat those businesses which are in fact unitary as independent entities. Separate accounting operates in a university of pretense. As in Alice in Wonderland, it turns reality into fancy and then pretends it is the real world. From the senator's brief, the unitary method of tax accounting is an integrated, conceptually fair basis of taxation which seeks to negate the intense complexities of intercorporate international tax accounting embodied in the arm's length method. The arm's length method treats each legal corporate entity as if it were real, while ignoring the identity of the whole enterprise. The unitary method identifies the income of the whole and then apportions that income according to the proportionate contribution to the taxing state. After the Supreme Court's 1994 decision New Hampshire did not repeal the water's edge method and return to the worldwide method. After I left the Department of Revenue in 1997, I felt compelled to file an amicus brief in Caterpillar's lawsuit against the department. I disagreed with the department and I disagreed with Caterpillar's position. Caterpillar argued that royalty and interest income from its foreign subsidiaries should not be taxable in New Hampshire, and in other words, should not be in their pre-apportionment tax base. And the alternative, Caterpillar wanted more weight in the apportionment factors. Either way, Caterpillar wanted to reduce the amount that they owed in business profits tax. I argued that the remedy was the worldwide combined reporting method that the U.S. Supreme Court said was unconstitutional, was constitutional with either a U.S. or foreign parent. I do not know if my amicus brief played any part in the court's unanimous decision where it stated, "We point out that the water's edge method was adopted for the benefit of foreign businesses." How else can you interpret or restate for the benefit of foreign businesses? This is preferential tax treatment, not for New Hampshire or Vermont or California corporations, but British, French, and German corporations operating in our state and throughout our country. It would be like a meals and rooms tax that offered a reduced tax rate or exemption for visitors from Canada or Spain. The legislature could pass this in order to attract more out-of-country visitors to New Hampshire, but would it be constitutional? I suspect this is why the water's edge method was not changed back to the worldwide method after the court's Barclays Bank decision. The state wanted to attract foreign corporations to New Hampshire, but at what expense? The DRA did not know what effect going from worldwide to water's edge would have on business profits tax revenues. The DRA does not know what effect going from water's edge back to worldwide would have on business profits tax revenues. All we know is that foreign corporations do not like the worldwide method. In House Bill 121 FN, Representative Schamberg said that the 1986 change to the water's edge method was a mistake. I would go further and say that the change was and is unconstitutional. The water's edge method violates equal protection under the 14th Amendment. It is unlawful, a bad law that discriminates. In prior cases, the courts have determined that corporations are persons and subject to equal protection under the 14th Amendment. I think of the water's edge method as affirmative action for foreign corporations to attract them to New Hampshire. Affirmative action is also referred to as positive discrimination. The water's edge method is positive discrimination in favor of foreign corporations. On the other side of that same coin is negative discrimination for our homegrown U.S. corporations. It is discrimination, pure and simple. The U.S. Supreme Court ruled earlier that affirmative action in college admissions was no longer valid. What would our founding fathers say about the state of New Hampshire, one of the original 13 British colonies that became a member state of the United States of America after the war against Britain for independence, against taxation without representation in Britain's parliament? What would Madison or Hamilton say about an American state that passed a law that granted preferential tax treatment to foreign corporations, to British, French, German corporations avoiding U.S. taxes that grants them an extra advantage in the U.S. marketplace competing against U.S. corporations? What would they say? Make no mistake, more multinational corporations of all stripes work to avoid corporate income taxes. They lobby to lower tax rates, to change the apportionment formula in their favor, and above all, reduce the tax base. If the tax base can be reduced to zero, then it doesn't matter what the tax rate is or what the apportionment formula is. I'd be willing to bet that there are a number of foreign-based corporations that operate in New Hampshire that have never paid any business profits tax. The GAO, the federal government's General Accountability Office, has reported that over 70% of foreign-controlled corporations in the U.S. have paid zero income taxes. This is why a number of U.S.-based multinational corporations have moved to a foreign country and a tax inversion. Multinational corporations go to great lengths to avoid taxes. The business profits tax playing field is not level. The law has to change to make it level. It has to be changed to move forward with unitary worldwide combined reporting for all corporations, big and small, U.S. or foreign-based. or it has to move backwards to the way it was from 1970 to 1981, where corporations filed separate accounting, separate entity tax returns, and the arm's length principle ruled over the unitary business principle. Big business would like that, a full return to the arm's length method. If New Hampshire did that, it would be the most tax-friendly state in the entire country. No general sales tax, no earned income tax, and the best possible corporate income tax. The new and improved New Hampshire advantage. Imagine being a clerk at the Vermont Department of Revenue in the 1970s when he or she opens a letter from the Mobil Oil Corporation and finds the check made out to the state of New Hampshire for $25. The initial reaction of that person must be thinking that this is some kind of joke. Mobil Oil has gas stations in Vermont and many states and is making hundreds of millions in corporate profits. And yet here's a check for $25 from the oil company to help pay for Vermont's public schools, public roads, public health, and many other functions that the Vermont government provides. The clerk enters the check into their system and sees that Mobil Oil also paid $25 in the previous year. At that time, Vermont had a minimum corporate income tax of $25, and that is what Mobil Oil paid to Vermont for each of the 2 years. The Vermont Department of Revenue conducted an audit, plus another one, 1970, and they found that they should have paid over $76,000. Vermont Oil protested, maintained that the Vermont tax returns were correct, and filed a lawsuit that went all the way up to the U.S. Supreme Court. The court records show that Mobil Oil had millions in Vermont sales and owned millions in Vermont property. Mobil Oil lost this case, and it was in that decision where the court stated, the linchpin of apportionability in the field of state income taxation is the unitary business principle. It is that principle that overrules the arm's length principle. The arm's length principle allows multinational corporations to shift profits from one state or one country to another. The water's edge method retains the arm's length principle, but only for multinational corporations. The worldwide method is the only way to overcome the arm's length method. In my Caterpillar brief, I argued that the Commerce Clause is the bulldozer that can and should make the playing field level, and that it is up to the New Hampshire Supreme Court to decide whether or not that bulldozer will be fired up and operated to flatten down this terribly uneven, unlevel, and unjust playing field of taxation in the global economy. In hindsight, I think I should have also argued that the water's edge method violates equal protection under the 14th Amendment. If the state of New Hampshire does not return to the worldwide method, I can only hope that a lawsuit will occur to test the water's edge method and find that it violates equal protection and/or the Commerce Clause. A lawsuit like the 1997 case against the state's interest and dividends tax. Ernest Smith was a lead plaintiff in a successful lawsuit against the 70-year-old tax. His lawyers argued that the I&D tax was flawed and violated the Commerce Clause and equal protection. Per the court's decision, prior to oral argument before this court, the state withdrew its Commerce Clause defenses based upon the U.S. Supreme Court's recent decision in Fulton Court v. Faulkner. Justice Souter delivered the unanimous decision of the court. The New Hampshire Supreme Court decided Smith's case on just the Commerce Clause. Unfortunately, it did not rule on the equal protection argument. Finally, I would like to quote Adam Looney, a Dartmouth grad and former Deputy Assistant Secretary for Tax Analysis at the United States Treasury Department. He said that, in effect, the United States is paying foreign investors to take over our own companies with our own tax dollars. Thank you.
Thank you very much, gentlemen. Are there questions? Representative Ruler, you're welcome.
Thank you. Excuse me for walking in a few minutes late, but for this, the lobbyist to answer for both of you could. New Hampshire has a unique system where the business profits tax and the business enterprise tax work together and offset each other under Supreme Court rule. I really don't understand how what has been suggested thus far applies in New Hampshire. So regarding equitable treatment, because every entity and every business entity is required to pay the business enterprise tax, and then that tax is offset against the profit tax of every entity. And under our rules, or under our constitution, each class is taxed the same. Each class of entity is taxed the same, even though they can have several different classes within a one appearing to be the similar group. So we're just, can you address that for me, please?
Well, sir, I'm not the tax expert, but fundamentally, under the current law in New Hampshire, we do not consider activities beyond the water's edge, beyond U.S. boundaries, in any case, for either for the BPT or the enterprise tax. We simply do not consider activities. So that if you're, as Mr. Gar pointed out, if you're a multinational or a foreign-owned company, you have the ability, again, perfectly legal, but putting New Hampshire businesses at a competitive disadvantage. Essentially, you have the ability to shift your profits around through accounting techniques or other tactics that enable you to reduce your liability to the state of New Hampshire. And the state of New Hampshire does not have the ability to audit activities overseas. There's no reporting.
Yes, go ahead.
Taking a very large company in New Hampshire, I think it's number 1 or number 2 employer, what do we care about shipbuilding in England?
What we care about, sir, is having a level playing field so that a New Hampshire business, a hardware store, for example, an independent bookstore competing against Amazon, a craft brewery competing against Anheuser-Busch, they are paying their full tax liability. They report 100% of their sales and then pay 100% of their tax liability based on that sales. A multinational corporation may or may not be reporting 100% of their sales activity in New Hampshire. They certainly have the ability through accounting techniques to shift what would rightfully be sales activity in the state of New Hampshire to other jurisdictions and thereby reduce their tax liability. And what that means is that a New Hampshire company is paying 100% of its tax liability. Foreign-owned companies or multinationals are paying less, potentially paying less than 100%. That's creating a competitive disadvantage. It's, you know, as Mr. Gar pointed out, it's not just unfair, it frankly should be illegal.
Any other questions? Mr. Wong?
Good morning. Thank you for your testimony. This is a first question, if I may. In your testimony, you mentioned this survey or this study, this January 2019 joint study by the American Sustainable Business Council. I'm not sure if the commission received has a copy of that study.
And I'm sorry, my my personal printer quit on me last night after I was printing out a bunch of our the testimony. I did email a copy of that study to Jennifer this morning, so the commission will have access to it. And again, I apologize for not having it in advance.
That's fine. Thank you. My second question is that you mentioned just now that potentially the multinational corporations could potentially shift their their New Hampshire sales activity to outside of New Hampshire. Can you just explain further on potentially how that mechanism is, how shifting sales that's in New Hampshire, how is that shifted outside of New Hampshire?
Sure. Let me give you an example of a pharmaceutical company. Pharmaceutical companies do a lot of research in the U.S. and they, you know, we've all seen the advertisements for Jardiance and various and sundry other, medicines for diabetes or rheumatoid arthritis, etc. What has happened in the past is prescriptions get written in New Hampshire for one of those medications, and that achieves obviously a certain sales level. But what happens is the pharmaceutical company transfers the patent for that medicine to a subsidiary or another company in a lower tax jurisdiction, the Cayman Islands, Ireland, wherever. And what happens is that the pharmaceutical company represents, let's say, $1 million in sales of a medicine in New Hampshire, but is required to pay a licensing fee to the Cayman Islands subsidiary. And that licensing fee significantly reduces that company's profits, as reflected based on New Hampshire sales. That's just one example.
Thank you. I believe the New Hampshire sales most likely would still remain as the amount of gross sales in New Hampshire. Probably I think what you're mentioning is what's being moved outside. It's just the shifting of the profits of the company in general, as opposed to the New Hampshire sales. I think New Hampshire sales will still remain as New Hampshire sales, right?
Except that it's my understanding, and correct me if I'm wrong, it's my understanding that a foreign company, a multinational company, is under no obligation to provide the same kind of reporting that U.S.-based companies have to provide. We have combined reporting within the U.S. so that if I'm a company that does business in New Hampshire and the other 50 states, I have to report to DRA what I'm doing, not just in New Hampshire, what sales activities I have in New Hampshire, but in the other 49 states. I do not have to do that for activities beyond the water's edge, which enables a company to use all sorts of accounting techniques to reduce their liability. In the end, it's the tax liability. It's not so much the specific how much sales they do.
Yes, Senator Murphy.
Thank you, Mr. Chairman. I'm holding in my hands the testimony from the Global Business Alliance, little 3-page handout. If I could sum up what's in front of me, what it says basically is, this would be new. We'd be the only state that does this. Every state that even allows for it, it's only an option. Each allows for a water's edge designation. And every state that studied it has said no. And states don't like to be outliers. We don't like to be first. And what I'm hearing now and reading in the testimony is this would actually be going back to a prior policy. So what would your answer be to the Global Business Alliance, please?
New Hampshire is an outlier state. We have no personal earned income tax. We have no general sales tax. The only other state that's comparable, I believe, is Alaska. But of course, they are rich in energy resources. So we're already there as an outlier. We have the New Hampshire advantage. We're supposedly famous for it. So funding a government has to come from somewhere. If we want to be the most business-friendly state in the country, then go back to the way it was between 1970 and 1981, when New Hampshire was a separate accounting, separate entity state. Revenues will drop, and whoever wants a general sales tax in this state, whoever wants a personal income tax or an income tax, they will have their time, they'll have their chance, because BBT revenues are going to drop off the cliff.
Let me just say we're not advocating that. But let me also point out that New Hampshire was an outlier in 1963 when we were the first state to adopt a state lottery. So we've done things. I think New Hampshire's pretty unique in a lot of different ways, and we've done things in the past. I'll also say that there are a number of other states that have looked at worldwide combined reporting and ending the water's edge. And very honestly, Senator, it's tough to compete with the money that big multinational corporations bring to these campaigns. The folks who are looking for equity, the folks who are looking for a level playing field, can't compete financially with Exxon, with Anheuser-Busch, with Home Depot, with Amazon. I know in Oregon, for example, Nike spent a lot of money to defeat this proposal, which came pretty close to passing in the Oregon legislature until Nike weighed in. Let's just say that. I know the state of Minnesota just this past year looked just a few months ago actually came again very, very close to passing this until there was some significant activity by the multinationals toward the end of that legislative session. So again, it's, you know, there, I'm not suggesting anybody acted outside the law. They didn't. But it's not always a fair fight.
Mr.
Senator
Chairman,
Sandberg.
hopefully this will be the last question we have. New Hampshire has adopted a single sales factor without any study being done beforehand or comparison study before it was adopted with the proportionality approach that we used. What, in your opinion, would be the effect of a single sales factor now being used have on the possible revenues for the state of New Hampshire?
I think it's going to be a disaster. We're a population of 1.3 million people. So how big can the sales factor be? And only the sales factor of items that are sold or services that are sold in New Hampshire without recognition of payroll and property. The corporations that have big plants, employ a lot of people, use our roads, you lose the rational relationship between sales, payroll, and property and the activity that's taking place in this state. You're moving away from that relationship and going to a pure single sales factor. I think it's a terrible mistake, and I think revenues are going to drop like a stone.
Thank you. I have three very brief clarifying questions. First, it's my understanding that you're not advocating going back to what prevailed from 1970 to 81, but rather what prevailed from 81 to 86.
That is correct.
Correct, sir.
Second, it's my understanding that the report that you forwarded this morning, which we'll see, is the one that establishes the claim of $177 million of lost revenue. And in contrast to the way it's written in the testimony, I believe you're saying that that's the impact on New Hampshire alone.
The report, which is called the title of which is A Simple Fix, looked nationally, looked across, you know, every state, and so there is a chart in there that identifies the potential loss in revenue to every state because of Water's Edge provisions.
So it's ascribing $177 million to New Hampshire specifically.
Yes, sir.
Okay.
In the chart, you'll see New Hampshire and 177 million ascribed as the estimated impact.
Okay. And third, it's my understanding that you're not picking who the villain is here between U.S.-based multinationals and foreign-based multinationals doing business here. They are equally a problem in the way you've described the issue. Am I correct?
That's correct. You know, any multinational corporation, regardless of where it's based, has this accounting ability, and again, the lack of required reporting that would give New Hampshire DRA, for example, the ability to audit globally their activities and compare them to what they do in New Hampshire. as opposed to the way they do it today, which is we can audit activities in other states. We simply can't, have any
Right.
any
It's the
ability to.
international aspect,
Yes, sir.
regardless of where the
It's the
corporation is.
international aspect completely. Yes, sir.
Okay. Thank you very much. And Mr. Gar, thanks for the extensive history, which I found very helpful. So we'll dismiss this panel. And before we go on, I just want to say, of course, we've run well over the time allotted. Don't fret. I'm aware. We might shorten our lunch break, and we'll just see how it paces along. So thank you, gentlemen.
Thank you.
So, yes.
Before we go to the next speaker, an allegation was, or a statement was made that raised a question in my mind regarding how businesses are report, and DRA is here, and I was hoping that we could probably get.
So the DRA will testify at the end of the line.
Thank you.
I would just, a quick insight. The plan for this progression anticipated that we would lead off, as we just have, with some New Hampshire-based businesses who are advocates for this proposal. And we're going to go through a variety of different spokesmen and perspectives, including practitioners and academic. But we are going to conclude with the DRA, and that's very much with the idea that we end up on a practical note in terms of what the actual hurdles of implementation, audit, and enforcement will be. Okay, so there's a method. So I'd like to welcome Meredith Beeson, Senior Director, State Government Affairs, who's here with us personally for the Global Business Alliance. And we also have Ellen Pasetsky, her colleague, federal and state tax policy consultant, who's joining us over the video link. So welcome, Ms. Beeson. Welcome, Mr. Pasetsky. It's
Great.
your
Ready to go. Good morning, Chair Spilsbury and members of the Study Commission on Worldwide Combined Reporting. My name is Meredith Beeson, and I'm here on behalf of the Global Business Alliance. You came up already, so I appreciate you reviewing some of what we submitted. I am here to express our concerns with mandatory worldwide combined reporting that you all have been tasked with studying. Thank you for the opportunity to share a perspective on the negative impacts that a mandatory tax policy such as this would have on the state. The Global Business Alliance, or GBA, proudly represents 200 American companies with a global heritage. Our members are headquartered in 23 different countries, all in places that are allied with the United States. And in fact, among all international employers here in the state, those from the United Kingdom, Canada, and Japan support the largest number of jobs here. The mission of GBA is to defend and promote an open economy that welcomes international companies to invest in America. Our members help grow New Hampshire's economy and provide high-quality jobs in local communities across the state. In fact, on average, U.S. workers at international companies earn 7% more than the economy-wide average. Over 50,000 people in New Hampshire are employed by international companies, and almost half of those jobs are in the manufacturing sector. And another great statistic is that employment from foreign direct investment, or FDI, has increased by 22% in the state, while the state's overall private sector employment has sadly decreased by 1%. It is clear that international companies are a vital part in creating a resilient economy, but our members also rely heavily on small businesses across the state that provide essential services, equipment, and products. I submitted a fact sheet for you all to learn more about our members' contributions to the state. So let's now talk about mandatory worldwide combined reporting. No other state in the union has taken this approach. Making a single tax approach mandatory like worldwide reporting can cause a lot of volatility and shifts in revenue. About half of states have adopted some form of what is called combined reporting. However, again, none have imposed mandatory worldwide combined reporting. In our work here in New Hampshire and in other states that have looked at this mandatory worldwide approach, we've actually heard from some of our companies that their liability would decrease, leaving the state with less revenue and more volatility. But more on that in a bit. States that have considered this tax policy have decided against it for a number of reasons, including the lack of predictable revenue. This worldwide policy could also have international ramifications and create unnecessary disputes with countries that are key trading partners with the United States. This is at a time when global connections are needed most. Worldwide reporting, as was mentioned, was first debated in the States in the 1980s, and some foreign governments even threatened to retaliate against the United States companies if these policies were adopted. Their concerns were that these policies would unfairly tax international companies, and as a response, states created a filing option allowing for what is called the True Water's Edge system. This generally means including only U.S. companies in the combined group. Every single state that offers worldwide as a filing option makes sure to have this water's edge approach. And whenever a state considers any form of combined reporting, GBA advocates generally for only the inclusion of U.S. companies in the tax filing group. This is what New Hampshire currently does. This allows for fair taxation and respects the principles of tax treaties. By contrast, worldwide combined reporting looks to tax a portion of the income of an entire global group. Again, not a single state has mandated worldwide combined reporting. And if New Hampshire adopts this mandatory approach, it will make the state a complete outlier. If this changes, taxpayers and state tax administrators alike are faced with considerable challenges. Issues like managing currency conversions, different accounting standards, various reporting requirements, and even language barriers, to name a few. As I stated at the beginning, and of particular importance to everyone here that helps set the state's budget, mandatory worldwide combined reporting creates revenue volatility. Unpredictable revenue is a byproduct of any kind of combined reporting, which could increase or decrease the revenues collected by the state. States such as Virginia and Maryland explored regular combined reporting, but neither adopted any form of it. So for a mandatory worldwide approach, that revenue uncertainty is exponentially greater. Not only would it require foreign company profits, but also global losses to be included in a combined return. Proponents of mandatory worldwide policies say it will bring in unprecedented revenue, but their methodology uses several troubling assumptions. Many of these studies, for example, were done before major federal tax reform even went into effect and are not accurate. If the state adopts mandatory worldwide combined reporting, unpredictable revenues are not the only issue. The state could see a dramatic increase in audit activity and prolonged litigation exposure, which creates risk. If this policy is imposed, it will hurt efforts to attract and retain international companies and damage the state's overall economic competitiveness. So, to recap my thoughts, again, no other state in the union has taken this approach. While regular combined reporting has been implemented in New Hampshire and many states, not a single one has imposed mandatory worldwide reporting. The state should preserve their current approach and avoid double taxation of income or retaliation from foreign governments. If imposed, worldwide combined reporting could not only cause erratic revenue, but could reduce corporate tax collections, which is dangerous when funding the state's priorities. Please consider how this policy could damage future growth and hurt relationships with key trade allies. Thank you for the opportunity to speak today. I will now turn it over to my colleague, Alan Pazetsky, to provide some additional insights.
Thanks, Meredith. I hope you all can hear me. Hello, Chair Spilsbury, members of the Commission.
Good morning. You're loud and clear.
Hello, Chair Spilsbury, members of the Commission. My name is Alan Pasetsky, and I'm a tax policy advisor for GBA. I have the unique perspective of working as a federal and state tax leader for a large corporation for over 30 years, which included dealing with all aspects of taxes, including audits and compliance. I cannot emphasize enough to this Commission the myriad of issues that mandatory worldwide combined reporting will create for New Hampshire. This state has prided itself on good tax policy for individuals and businesses and is often ranked as a favorable destination for investment. In fact, I was up in Concord in April testifying in support of SB 189, which allows corporations to take a tax deduction for interest on loans that can be used to invest in the state. This bill passed unanimously and was signed by the governor because this state continues to acknowledge that taxes should not be an impediment to job growth. I would like to thank all of you for your support on that very important bill. But if you were to implement mandatory worldwide combined reporting now, the state would be going backwards. And it would undo all of the goodwill New Hampshire has built up to encourage the business community to invest and create jobs. Worldwide combining is not a new concept, as you have heard. When the states first started to adopt these proposals decades ago, it was insanely complicated and produced long, drawn-out audits, as well as other issues which Meredith has raised earlier. Other than perhaps the good music of the 1980s, there is no reason to go back in time and revisit tax policies that were deemed harmful to Americans and American workers. It should be noted, though, that New Hampshire, unlike many states, already taxes certain foreign income, including dividends. Some of this revenue collected from that foreign income could actually be compromised with a change to mandatory worldwide combined reporting. Another thing I can speak to firsthand is the huge administrative burden to do calculations for a worldwide tax return. You may hear from others later today who have never worked internally for a business, but these worldwide calculations are extremely complicated. Think about it. Is the person that's doing taxes for a business based in Manchester supposed to reach out to company contacts around the globe? International companies may not be willing or be able to share private data, not knowing where it may end up. The relevant profit and loss data that will need to be collected will not be calculated in US currency, US accounting, or US tax principles. This complexity will not only be challenging for companies, but for the state, requiring additional audit staff and resources, not to mention the eventual onslaught of litigation that will result. In addition to all this complexity, as Meredith indicated, one of the biggest issues you should consider is the unpredictable impact this may have on your revenue. No one can honestly tell you what the income or loss of international companies around the world will be annually, or the impact on New Hampshire's revenues. The bottom line is that the impact will be dependent upon the global facts for each company's group and which companies globally are allowed to be included in the group. Again, this policy would make New Hampshire a complete outlier, and I urge you not to gamble with a controversial tax system that has unknown revenue results, creates complexity, and deters investment. Thank you, and we are happy to take any questions.
Thank you very much. Representative Ullery.
Thank you, Mr. Chair. Jordan Ullery, Hudson, representing Hudson. Listening to the testimony that you've given thus far and to the information that was provided previously, I'm a little concerned that using that large employer here in New Hampshire, if that company were to have a loss in, say, shipbuilding in Northern England, could they not then just shift as a business cost anything that the profits that were made from selling avionics in New Hampshire to cover the losses in building ships in England? And that would be, under worldwide reporting, a legitimate shift of funds to cover business expenses. So there would be no taxation in New Hampshire because it's a business expense. Was that a scenario that could exist?
I'll start it off, Alan, and then you can chime in. I think one of the things that I wanted to underscore in our testimony was that the idea of global losses aren't often accounted for when the proponents are talking about the estimations of revenue included. So you're exactly right. If you mandate all of these subsidiaries or foreign parent to be included into a combined group without any connection to New Hampshire operations, you could change the apportionment of how a company would need to file or be liable for taxes paid in New Hampshire, right? So it could reduce that revenue that the state eventually collects because there's global losses being folded into a group than just the single sales factor. Alan, anything to add on that?
No, I think that's just a good point. People think about this as it's worldwide, it's the entire world group. First of all, it is only certain members of the group that meet certain criteria. The DRA can comment on that later, but there has to be a connection of some sort between the foreign company and the US company, whether it be ownership of, common officers, a shipment of goods, or there's a whole plethora of issues that could get you included. And those rules are very subjective. So first, like you said, Representative, you could bring in losses. You could bring in losses of certain companies and not others. This is a Pandora's box that would be reopened for basically no reason, because as Meredith said, the revenue uncertainty drives the conclusion here.
Representative Schamberg.
Thank you. Representative Tom Schamberg, Merrimack 6. Mr. Potensky? Pasetsky. First question for you. Do you know what the purpose of our tax policy is for New Hampshire through Ways and Means?
Representative
Well-
Chan, I'm not sure. What is the first?
Yeah.
I'm not trying to understand the question.
Well, I just want to make sure that we understand what we're trying to do for the citizens of New Hampshire. Our obligation to the citizens of New Hampshire is to assure a fair and level playing field for its taxpayers. And our tax laws have to make sure that they are fair and level. And this is probably the only one that really, really has some deficits to it for policy.
Okay, now, so let me try to answer your question. The policy you currently have, and let's look at the whole country and then we'll focus on New Hampshire.
Okay.
As earlier testimony indicated, companies can file basically in two ways. As a separate company, each US company files a return in New Hampshire, or as a group. You and New Hampshire have chosen combined reporting of those US companies. About 27 states, so roughly about half of the country has that kind of reporting. It has been determined by almost all these states that that is an appropriate method of reporting. You can argue both ways. What's exactly the right amount of tax, we don't know. But as far as not creating a playing field globally, global companies, and earlier testimony mentioned Home Depot, which is a US company, again, international, but US based. We all have the same tax returns to file. We all have the same calculation of income and loss to come down to taxable income with the same New Hampshire tax rate. Do certain companies have advantages because they have foreign affiliates? Well, they have a situation where they could pay expenses to a foreign affiliate because that's where they're incorporated. That's where they are set up. The company I used to work for was established long before there was a federal income tax code. And it was an earlier testimony, again, I'll keep referring to, where it talked about paying a licensing fee of pharma companies because they transfer a patent. Well, if it's an abusive situation, it can be dealt with at the audit level or at the federal audit level. But if that company established that patent because it was incorporated in the Netherlands in 1845, and all of their patents are there, and now that company has to pay a license fee to use that patent, that is legitimate business expense and doesn't create an unlevel field, because for the companies that are US-based companies, pharma companies and the like, they would have the patent in the US and they would receive that licensing income. It's really a matter of general business setups. It's an organization that is established that way. And again, I think, Representative Schamberg, a lot of the focus is going to be on abusive transactions. And we don't shut down the street because a few people are jaywalking. I think those abuses, if they're out there, need to be addressed by auditors at the state and federal level.
May I follow up with another question, either for
Yes,
Meredith
go
or
ahead.
for Alan? Regarding the statement about the complexity of trying to do audits, Does the DRA in New Hampshire, would you say they have the authority to require the corporations to report that information that we need to determine their tax liability directly on their New Hampshire corporation corporate tax returns? Could that be done? And follow up on that one is, you talk about complexity of languages and things like this. What is the basic language that we use in across the world today to do business arrangements?
Representative Schamberg, I'll take a first pass. You know, I definitely want the department to speak on, I don't want to speak on the department's behalf. I think they can require certain information, but again, I think it is challenging for companies when you're managing conversions and different accounting standards across multiple different countries. And languages do still vary. I'm not as familiar, and I'll turn it over to Alan to take it from a global perspective, but I do think that there's still various different tax return information. Like different governments don't have the same type of lines that we do at the Internal Revenue Code. And when a federal tax reform is, or federal tax filing is done here, it looks different than a Swiss tax return or a Canadian tax return. And that's not just language, it's currency, it's various other things.
Yeah, Meredith, I would agree. I mean, think about it again. At your foreign parented headquarters, you're likely, Representative Schamberg, to have a language that everyone speaks. Maybe English, depends on the country. But that's not what we're talking about here. We're talking about a company in the US, in New Hampshire, now having to decide which of its affiliates around the world belong in its group based on the facts of that affiliate and its interplay with the US company. Which means I'm going to have my state tax person reach out to, say, someone in South Africa or in, Brazil or in any country and have a thorough discussion on whether that company perhaps should be in the group. And if it should be in the group, how to get their income, which will be computed under completely different principles. The tax returns in other countries look nothing like ours. Every country has their own different system. They don't even start with sales. Often they start at different levels and build up. To translate that into a consistent apples to apples calculation to be used in a New Hampshire tax return. So it is a very complicated calculation. And then the DRA will have to audit that. And I don't know how they have the resources to determine if those numbers are even remotely accurate.
Thank you for that answer. And then my last follow-up here. Do
Let's-
either one, I had my third question. I don't want to lose track. Do either one of you know if there was ever a secret arrangement between the U.S. government through the White House with Great Britain to move away from worldwide combined reporting with states like New Hampshire and California?
Representative Schamberg, I'm not personally familiar with that. I do know a lot of countries threatened to retaliate if states did pass bills. So there was, if measures were, they were waiting in the wings if states move forward with worldwide combined reporting. So I hope that answers your question.
It sort of answers it. Thank you.
Yep.
Questions from other members? One question, Ms. Beeson. You mentioned that you have 200 members. I imagine if I went to the website, I might find a list, but can you provide us a list of the members?
Yes, absolutely.
Great, thank you.
Yeah, thank you.
I have a question.
Yes, Mr. Kennedy.
Relative to the issue of retaliation from the foreign entities and things like that, you have anything even speculative as to like what that looks like in terms of potentially businesses not coming in or leaving the state because we moved to this, and in conjunction with that, assuming companies didn't retaliate, didn't leave the state, there have been numbers that have been indicated that if we move to worldwide reporting, revenues would increase by a significant amount. Is it your sense that if there wasn't a retaliation, that moving to worldwide reporting would increase revenues to the state, and then I presume your argument is that, yeah, potentially it would go, revenues might go up if nobody left, but the offset to that is companies would leave, so revenues would go down. I'm just trying to understand your position on the controversy between those two ideas.
Yes, thank you for the question. I think it's worth clarifying that when we use retaliation, it was actually retaliation by other governments against U.S. companies who do business in those places, right? So I'm not saying on behalf of our members that individual companies would retaliate or choose to leave. I think they might have a lot of complexity and additional burdens when they're putting together these worldwide calculations. But I want to underscore that U.S. companies might be hurt by all the other countries that try to respond and do something similar, right? So that is that notion of the retaliation piece. And I thank you for the question on revenue. You know, I wanted to underscore that some of our members actually like a worldwide approach. They like it as an option. And that goes directly to the point of potential revenues could decrease here in the state if this is imposed, because it does pick winners and losers. So some companies would pay more in liability while others would see a reduction in their tax liability. And I think that surprises a lot of people because they assume by mandating a worldwide group that it's just going to bring in all these profits, which again are it's not being considered that global losses would also be part of that.
One more question relative to the complexity, and certainly I think it's understood that there would be various levels of complexity by moving to this, but in terms of information gathering, the federal return requires a lot of foreign reporting, whether it's a 5471 and reporting your subsidiary activity or foreign companies with U.S. operations. I'm interested in your response when people say, well, no, that information's already available on the federal return, so the state would have less issues with kind of compiling that information for worldwide reporting. What's your response to when people are thinking relative to the reporting associated on the federal return?
Great question. I think, and I'll let Alan back me up, but the federal consolidated group is a very different group than what would be required under a state combined return or mandatory worldwide return. And I think it's a lot of moving pieces, right? When you think of a federal return as a company's usual federal consolidated group. And so a state tax return, what is effectively connected income, or what is connected to activities here in the state, looks different. That group will look different. But you're right that any federal amended return is also going to be reflected on the state side, right? So if an adjusted return is done at the federal level, then you've also got that as a starting point with a New Hampshire tax return. Anything to add?
Yeah, let me add a little bit. It's a great question, by the way. You mentioned 5471s. 5471s are forms that certain companies file that have foreign subsidiaries, right? So there will be some data on those forms that perhaps could be used here. I guess we don't know what the language would be, what would be required, but we are also talking about a much larger group of companies that are not foreign subsidiaries. They're not under the U.S. group. There will be no information or very limited information in a U.S. tax return related to those companies. So it's two different groups of foreign companies that we'd be looking at. One's under the U.S., the one's not under the U.S.
So if I can just follow up, because that anticipated a question I wanted to ask. The audit challenge, when an issue arises, is likely to require reach into data that goes beyond what would be found in the federal income tax return. Is that correct?
That is correct.
That is correct.
Okay, seeing no more questions. Excellent testimony. Thank you very much, both of you.
Thank
And
you
Mr.
for
Pasetsky,
letting us
thanks
have this
for
opportunity.
dialing in. Okay, our next presentation is from Walter Hellerstein, Distinguished Research Professor, and Francis Shackelford, Distinguished Professor in Taxation Law Emeritus at the University of Georgia School of Law, and Visiting Professor, Vienna University of Economics and Business. And Professor Hellerstein has come to us from Georgia, so thank you for making the trip. There you
Yes,
go.
okay. Thank you very much. It's an honor and privilege to be here. And I guess as I'm listening to the earlier testimony, I'm sort of reminded of where I've been. Actually, I want to start with my first slide. Where's the button for the?
They're coming up.
Your slide is looking good.
Yeah, I know. I just want to be able to move it. Got it. Get rid of that. Yes. Like, I'm not sure I really need to go beyond my first sentence, which is it's my favorite quote from the U.S. Supreme Court Justice Oliver Wendell Holmes. And the longer history I live, the more I realize this is true. That the history here and the logic are not exactly on the same page. And I think it's really important to understand how we got to where we are, why we're here, and maybe what's the right way to approach this. And I want to say another thing. These are things I've been doing this for so long that I've said to somebody else earlier that, when I get a call, oh, Professor, would you like to be an expert witness? I mean, I've argued before the Supreme Court. I've represented clients. And at this point I say, well, what am I going to say when I'm testifying under oath? And I'm asked on cross-examination, well, Professor, didn't you say something a little bit different in your treatise? And I said, oh, yes, Your Honor, but I think better for money. The point is, I'm really here. I'm hoping, I don't, I think this is a complicated issue. There are, as we've already heard, two sides to this issue, but I really believe that one thing that may be very informative, and I realize, my time will be up pretty soon, is just to go through that history without completely repeating what everybody said, but just to understand how we got to where we are and what we might do given where we are. So, the history, this is the history that, that I think many of us sitting around this table looking at gray hair are familiar with, is that the very notion of combined reporting, both on a domestic and a global basis, was something that developed over the years. In fact, again, we take a step back when everybody thought that a separate entity meant they were to be respected fully and not, don't tamper with what the lawyers did, don't tamper with where the separate entity may be best based, whether it's in Delaware, with a nice tax haven, or in Ireland, if you want to do it globally. And the standard for deciding where income is earned was something that we all, I think, familiar with, particularly at the federal level, the arm's length separate accounting standard. Well, again, to sort of fast forward, I think we all know that the states, before we even got to worldwide combined reporting, they quickly understood, first of all, they understood that formulary apportionment rather than arm's length separate accounting was the appropriate way to approach this. And again, for much of my life, I go over to Europe and I was explaining to the OECD, Jeffrey Owens, who's a good friend of mine, chairman of the tax part of the OECD, explaining, we'd have debates, formulary apportionment versus separate accounting. And I would explain the history of formulary apportionment and why maybe it made more sense, because that meant that businesses couldn't just put their entity in a particular jurisdiction and pay fewer taxes. And he would say, look, this is the global standard. Everybody understands it's arm's length pricing, and it works pretty well. Again, let's fast forward then through the fact that the states all developed, adopted, embraced the notion that formulary apportionment, we do it by formula. We don't try to pretend that if I sell something from New York into New Jersey, we're going to figure out what would be the, if you were two unrelated entities, what would be the price of that sale? We put them all together, fine. And then we get to the point of the mid 1970s and 1990s when states started to realize that, wait a minute, as the universe expanded, the system we have subnationally, or at least the system we have, within the states, the formulary apportionment that everybody accepted by the, there was no question about that by the 1950s. State didn't have, or 60 states didn't have arm's length separate accounting. But now the question is, how far does that go when you're dealing with lots of related corporations? And again, not to repeat too much, everybody knows about container. That was the sort of the and I think one thing I wanted to point out, I looked through there, if you look at the dates of the cases that actually litigated this, the dates were 1983 for container and 1994 for Barclays, but in fact, the actual tax periods were much earlier. For example, the tax date in Barclays was 1977. So the point is, in some ways, the universe had already moved by the time the court decided these cases. But basically, in both container, in the 70s and 80s, states realized that they should include all related entities that are engaged in a unitary business. I don't need to explain that to anybody. And we shouldn't just stop because I've happened to set up a business in the Grand Cayman Islands rather than in Delaware. So again, I think we've already heard some of this today. Multinational corporations very understandably said, this is terrible. You're putting everything into the same pot. We have this well-accepted standard of arm's length separate accounting that everybody knows how to deal with, at least everybody in the global context. And now you're creating all these problems. You're going to create a risk of international multiple taxation. You're going to prevent the United States from speaking with one voice. Remember, we're talking subnationally. Globally, it's arm's length separate accounting and has been. But again, just to fast forward beyond my testimony, guess what, folks? There's a huge debate going on globally about how businesses should be taxed. And maybe the arm's length separate accounting will be, maybe, long when I'm gone, by something a little bit different. Perhaps what we're talking about now, where you have the OECD and the world talking about formulary apportionment for part of a tax base, and understanding that maybe the pre-existing arm's length separate accounting norm is, maybe a thing of the past at some point. Not yet. We're still at the position where arm's length separate accounting is the norm globally. But I think it's important to understand this difference, what's going on subnationally and internationally. So when we early on said it was a problem, creates the risk of international multiple taxation because states are doing things that are different from what the global community is doing. These were arguments that were made. I'll keep going here. And in container, the court looked at that and said, these are good arguments. The people who bill by the hour make them, and they make them well. But the risk of international multiple taxation was not inevitable. Indeed, if you look at different determinations of the arm's length price in two different jurisdictions, you could have multiple taxation. Should California give up one method? In other words, neither is perfect. I think that's something that maybe the folks behind me are going to. Nothing. Formulary apportionment is not perfect, but neither is arm's length separate accounting. Although, again, if I'm now billing by the hour, and I say, yes, I'm going to set up, just to give you another example of one I've lived through. I like Jeffrey. Remember Jeffrey the giraffe? Okay, Jeffrey. You went into the Toys R Us and you bought something from Jeffrey, and guess what? There was, money was made, including royalties paid for that very nice picture of the giraffe. Well, guess where all the royalties were paid to? Delaware, which didn't tax. So I've set up a separate subsidiary to make sure that none of the other states could tax a piece of the royalties that wouldn't exist if you hadn't made the sale into the state where they were purchased. Well, we got over that. We realized at the subnational level that we can deal with that, whether it's through combined reporting or by the way, saying that there's nexus over the company that is directing all its attention to Toys R Us in the state of Georgia. But just moving on. The court rejected the possibility. They're real. They're not made up. There are problems, foreign retaliation, frustration of federal policy, arm's length. But the court said, look, this is national. We're dealing with constitutional issues. We don't, if the Congress tomorrow, persuaded by the business community, wants to say that it's a violation of the Foreign Commerce Clause, which is Congress's power to have the states do anything other than arm's length separate accounting, they can do it. But Congress, court has to say that. So in Barclays, again, it becomes even more the case involving a foreign-based company, not at least Containers, a U.S. company. Same questions were raised that if California can require arm's length separate accounting, it's going to create all kinds of havoc in terms of how states comply, and very expensive. And these are not made up. At the end of I'm going to tell you now to skip to my conclusion. I'm not coming in on one side or the other, but just understand how we got to where we are and why we have this debate. And it's a real debate. And I'm not sure either side, I wouldn't take either side on a contingency. Let's put it that way. Move on. Okay, in Barclays, again, all the issues that are being raised here were addressed by the U.S. Supreme Court. And again, they dismissed them not because they were frivolous, but just because these general requirements that states must abide by, they can't discriminate against interstate commerce. We can't say in Georgia that anything made in South Carolina that's sold in Georgia is taxable, or anything, we'd probably like to, but anything made in Georgia, sold in Georgia isn't. Can't do that. But the point is, these general constitutional restraints, which are understandable, the court said we can't impose those sorts of requirements on the states. Congress obviously has the power to do that. Keep going. Then what happened? And here's my page of history, right? So the U.S. Supreme Court says, there are issues here, but we think the states are acting reasonably. At least they're acting within constitutional parameters to be doing what they're doing, and to have not just combination, but worldwide combination. If someone can show that this worldwide combination imposes a tax that's out of complete proportion to what's going on in the state, taxpayer wins, because that violates the Commerce Clause and probably the Due Process Clause. But to say as a general principle that states can't do whatever the federal government has done under federal law, that we're not in a position to do anything about it. So now let's get to where we are now. After Container, what happened? And here the best thing I could do, I hadn't looked at this, took this off my shelf. Haven't read this stuff hold it up to the people on the screen too. This is the final report of the Worldwide Unitary Taxation Working Group, August 1984, right? Time flies when you're having fun. By the way, remember, this was 84. Container was 83. This was 1 year after Container and long before Barclays. And there was and again, I don't have 3 hours, but I think this is something worth reading. Bottom line, this group, which was a federally created group under Ronald Reagan, said we really need to deal with this problem through federal legislation. And that makes sense, right? Court said we're not going to do anything. So what are you going to do? You go to the legislature. What should happen is this: water's edge. We should have water's edge combination. That means combination's fine. We're not rejecting that. But if one of the entities does much of its business abroad, 80%, they're not going to be. You shouldn't really include them, because it creates a lot of the problems we've heard the business community talk about. What we also should have is increased federal administrative cooperation with the states. Let's all work together, states and the federal government, to create a nice, good system nationally and subnationally. And let's have competitive balance. We don't want to, foreign multinationals should be treated no better, no worse than purely domestic businesses. And of course, guess what? There was a failure to reach agreement. No big surprise. And by the way, I have to. I was in 1985. I just again the 84 report says states should adopt legislation, but there was a certain uncertainty about this. I thought one thing that was very interesting, and I don't know how many of you remember Byron L. Dorgan, who is a senator from North Dakota. And North Dakota was a very, in terms of taxation, it was, I would say, I don't know, it was on the front end of doing what states might be, businesses might complain about them. And Dorgan wanted to know, because he kind of liked what he saw. He said, I'll just response from the GAO, the Government Accounting. This report responds to your request for information on California's experience in conducting formulary apportionment of multinational corporations and issues that would have to be considered before adopting a formulary system at the federal level. You know, some people in the federal government thought what the states are doing makes a lot of sense. Why arm's length separate accounting? Formulary apportionment understands we got an economic unit, and maybe we should assign this based on where the activity takes place. Under the state system, it would have been where your people are, your property is, where your people are, labor, where your property is, capital, and where your sales are. That was the notion. That is the notion under the three-factor formula. Well, what's happened since then? Again, I think maybe, even though I may not be talking directly about a lot of this stuff, this is really relevant. A lot of things have happened. First of all, in response to, let's just get to the response to the working group, and that's why we're here. In response to the threat of federal legislation, state after state after state basically repealed or limited worldwide combined reporting. And I'll get to this is the key slide, right? With the highlight of New Hampshire. They all essentially, depending on what side of the street you're on, they caved in to the pressure from whether it's Japan or the federal government or good business lobbyists, and they all, with a very few exceptions, adopted legislation that restrained worldwide combined reporting. Was this a matter of thoughtful academic determination? No, I think it was lobbying. There were real issues, but I think that's where by 1991, all states had adopted water's edge legislation. I think somewhat ironically, it was in 1993 that the court in Barclays actually addressed the constitutionality of what the states have been doing in the past, but were now had now voluntarily, and I put that in quotes, decided they did not want to do. And again, I want to get back to where where we are now, and then take any questions. I hope some as to what we might do. And there's one other thing I want to refer to. Again, the states basically adopted, the states abandoned worldwide combination for reasons that I've suggested, I think largely for political reasons. Not that the political arguments are all nonsense, but just that they were motivated by that rather than, I think, saying, what's the best way? Indeed, if the federal government had listened to Byron Dorgan, maybe we would all have formulary apportionment at the national level and wouldn't be talking about this. And by the way, just to say this again, international level, they're thinking about that, right? Formulary apportionment is now part of the global pillar. I don't know how many people know Pillar 1, Pillar 2, how we should apportion income at the global level. And there's a big debate about that, including that market states ought to get a piece of the pie, as it were, even if you're not physically there. So maybe and Pillar 2, how do we deal with all these problems? And finally, I come back to where I sort of started. The rush to restrict combined reporting didn't grow out of the philosophical conversion from formulary apportionment to separate accounting. I think they yielded to economic and political pressures, which may be somewhat legitimate, but I think that's really where we are today. And I think it's important to hear, obviously, from both sides, but also maybe from the middle. And here's what I want to end with. I'm leaving maybe too much time for questions, but I thought as I was going through my files, that's what I do these days. In some ways, almost one of the most interesting pieces of documents that I think everybody should read. Maybe how many here know about the combined reporting study of Indiana? Anybody familiar with that? Okay. It's because Indiana, in October 2016, and what's good about this this is a more, you know, we're 20 years later when the universe I think is that we live in is more understandable. And they wanted to consider, since Indiana was, they were definitely unlike most states. They didn't even use combined reporting. It's separate company reporting. And what this study does, it analyzes the costs and benefits of combined reporting. And that's, I think, that's what you guys need to do. There are obviously some costs and there are obviously some benefits. And I think, the answer is not clear. I'll just read you part of the executive summary is, while combined reporting neutralizes several planning strategies like the use of intellectual property, holding companies, transfer pricing, captive real estate, it could also create different complexities in the determination of the unitary group. Again, I'm not going to read it all to you. I just wanted to get to I think the ultimate conclusion, and this is where I'm going to end for the moment. We use economic techniques to examine how state tax policies, including combined reporting, influence state corporate income tax revenue. This method controls for variation in the tax base related to the economic cycle and other tax policies and the impact from combined reporting. The economic results suggest that combined reporting may have an initial positive impact on corporate income tax revenue, but that this impact is not lasting. We estimate that the initial positive impact could potentially be economically significant. However, we also estimate that the impact will only be short term and will decline to zero in the long run. So again, I'm not weighing in on that, but I just think what everybody around this table ought to do is look at the history. And again, I think this 2016 report is pretty interesting because that's just saying, should Indiana even just go to combined reporting? And as I say at the end of testimony when I used to give it, further affiant saith not.
Okay, thank you very much. Can you send us a link to that study, the Indiana one,
Oh yeah, I'll give it. Yeah, I mean it's.
and the 1984 working group?
This. Okay, yeah, sure. I can send you links to everything. Yeah.
Good on that.
And maybe before we leave, I'll talk to somebody I'll just give you, show you.
Representative Ullery has a question.
Yeah.
Well, actually, 3 questions.
Oh, good.
3 questions. Go for it.
Well, the first question is the same one that I asked previously regarding legitimate business expenses and transfer of funds from this company because of a loss in another division somewhere around the world. That would, under combined reporting, could the revenue that would be due to the operations within New Hampshire be transferred to pay for a lost lead because of some developmental process taking place in India or England or wherever?
Under combined reporting, the point is that you would combine. That's why it's called combined reporting. You would basically combine all the income. You'd have to have a standard for determining the income of all the related companies. And then you would say, where is that income earned based on your formula? Again, looking back to the earlier time when states, if you used where's the property, where's the payroll, where are the sales, or today, where are the sales? So, I mean, you would use a formula to take the combined income, so you wouldn't worry. Intercompany transactions you wouldn't have arm's length separate accounting determining did they lease to their Grand Cayman Island subsidiary at a reasonable price or whatever.
So, okay, so under this combined reporting would be the entire, but you'd still have to have some sort of nexus within New Hampshire as to what New Hampshire.
You would only have to have only one of your entities would have to have nexus. So you could have one entity with a bunch of, people and property in New Hampshire and everything else abroad, but everything they were doing was integrally related to what was going on in New Hampshire, and the apportionment formula would include the income of the combined group assigned to New Hampshire based on whatever the formula was.
That leads to the next question regarding the Wayfair decision in New Hampshire, which changed the perception of nexus to point of this.
Well, it didn't really. Here's okay. It's good. This is my page of history, which is good. Remember I told you about the Jeffrey case?
Wayfair.
No, I know you're saying Wayfair. I'm talking saying Jeffrey. Jeffrey was the case involving the giraffe, and
Okay.
and actually involved whether or not there was a connection. If all I do, Jeffrey said, "Hey, all I'm doing is licensing my
Image.
image to folks," and the court said that's enough. What you're talking about is Wayfair, where the court early on decided that for income tax purposes, you don't have to have a physical presence. Quill said you did, okay, and then when the court reconsidered the case, they said no, we're not holding everybody to the physical presence. We're not holding income tax jurisdiction to the physical presence standard. And then Wayfair came along and finally said, oh, of course, we mean the same thing that we said about income taxation for sales and use taxation. So in fact, the physical presence standard in the indirect tax concept, sales tax, VAT, has long, that's all a matter of history. If you understand what I'm saying?
Not quite.
In other words, the case that reaffirmed the physical presence concept in the Quill case, what 80, I've got it cited here. It basically said, it said, because there was an attack on the physical presence concept long before Wayfair case. They said, we're not saying this applies everywhere, but in the sales and use tax context, it does. So in the income tax context, there has long been what I'll call an economic presence rather than a physical presence concept at the subnational level. At the international level, of course, if you've got, need to have a permanent establishment or whatever your global standard is, depending on whether you've got a treaty with the U.S. or not, that may be different.
Okay.
Sorry, I mean, that's just the way the law developed. Yeah.
Yeah, it's an ongoing discussion, and we've had it in Ways and Means repeatedly here.
Yeah.
Which leads up to the next question. Just based upon your research, business tax revenues under the condition 1981 to 1986 were X. Did the business revenues to the states increase or decrease after 1986?
Yeah, I have no, I cannot, I don't know. And I think this Indiana study may be very useful for you.
Okay. Thank you.
Yeah.
Thank you for that.
Very good. Other questions?
You mentioned the OECD and kind of the international.
Yeah.
You
That's
know,
where I spend most of my
debate,
time these days.
Yeah, that's going on, and I was hoping you could help us just kind of understand worldwide water's edge inbound companies and outbound companies, right, and the taxation thereof as a result of this, right? So outbounds now we do have GILTI that comes into play, and we have kind of a charge coming up, a dividend that's coming up. It's in the tax base. Obviously for inbounds where we have a lot of related affiliates that aren't in the group currently that would be exposed. If you could just kind of educate us on that just to make sure we're all
No, but all I can,
capturing
yeah,
that.
I can and I can't. I can educate you in the one sense for what's going on in terms of domestic national direct taxation, federal income taxation, and how that affects foreign commerce. That's all a question for Congress. And some of the things that are going on or not going on are a matter of intense debate. But that's quite different from the debate that's going on globally at the OECD, where I think there, again, I like to say this because I think there's been a recognition, at least not by every country and not by, but a recognition that the pre-existing system does not fairly attribute income to where it's earned. I'll give you probably the best example. If a company Facebook makes its money by when I log on or whoever it is by knowing where I am and say, oh, Walter, I see you're in New Hampshire. How would you like to buy something? How do you know I'm in New Hampshire? Because I've just logged on to something and my eyeballs have been sold. Guess what? So now the question is, and then of course I buy something, and what's going on globally is understanding that, even if a company is only selling eyeballs in some jurisdiction, some of their income ought to be attributed to that jurisdiction. Not all, but some. I mean, I'm just giving a, so that's there's pillar 1 and pillar 2. So under one of the pillars, we understand that there ought to be some income attributed to market jurisdictions, even without physical presence. And then the rest of the balances should be, again, the international regimes are trying to figure out what's the best way for traditional income based on where people are located. Arm's length separate accounting, or do we need to vary that and make changes? But that's all a moving target now. I mean, there's not uniform agreement. I'm sure that'll be long gone when as and if they finally decide what the right answer is. And then the question is whether or not, the U.S. agrees. But anyway, that's where we are. It's great for lawyers or for people who are involved in this, but there's no, you're not going to find an answer there yet. But you will find at least every question that's being asked here today is a question that's being asked all globally, particularly with regard to income. Fortunately, I just have to say this. When I go to OECD, I'm dealing with what's really the easy issue. It's sales, VAT. We all know how VAT ought to work, and we all know that destination-based is right. And then the only question is how to do it in a way that's, that makes sense to other jurisdictions. But there's not a debate as to where the consumption ought to be taxed. Consumption ought to be taxed where consumption occurs. It's a consumption tax if you have a good consumption tax.
Mr. Wong?
Good morning. Thank you for
Good
taking my
morning.
question. Now, I believe that one of the main concerns is that the local domestic companies are competing with multinational companies that has CFCs or foreign subsidiaries, and therefore there's this risk of base erosion and profit shifting. Now, New Hampshire is conforming to the Tax Cuts and Jobs Act, and specifically, we adopted a GILTI for taxable income purposes. What is your thoughts on the mechanism of GILTI in terms of trying to abate the base erosion and profit shifting?
It's a great question, and I think it depends. And all I can do is say, terrible answer, but that's the right answer. I mean, what are you conforming to? Are you conforming to something that would attribute income to U.S. subnational jurisdictions? And you have to look, how does it flow through? What's going on? Again, we just had a recent issue about, should states conform to whatever the most recent federal development is? And again, it depends. And I think a lot of it depends at the federal level. All they're talking about, or not all, but at the federal, they're talking about what's in the tax base. They're not talking about where the tax base goes. That's be arm's length separate accounting. So, I mean, when we talk about whether it's GILTI or talk about other developments that are at the federal level, I think one has to sort of translate that into, if you're just talking about the base, does the state think that they like that change in the base? They normally would, because states normally conform to the federal unless they decide not to. So it's complicated, but I think maybe some of these materials would help.
Yes, Representative Schamberg.
I'll try to make this one short. Thank you, Professor Hallerstein. Virginia undertook a study like that. I didn't know about the 2016 Indiana one.
Yeah, neither did I until,
So hey, we're both in the same class.
Yeah.
Now, all right. And they're doing a comparison study of what their present tax system is and worldwide combined reporting. And it's a 5-year program that they're running. So maybe you can look that up sometime.
Oh
in
yeah,
the
but
future.
did they base? But I mean, they based on based on their existing
Existing with
Right. hypothetical
what would have
application.
happened if we
Yeah.
had done this.
Interesting.
So-
That's very important.
Okay. The GAO in 1993.
So wait, so you're not talking? Okay, GAO.
Yeah, the GAO. It's just a question about would we have been better off? Would we be better off moving to the worldwide combined reporting versus what we are presently doing because of what they said then? in their 1989 to 1990 tax data, 72% of foreign controlled corporations paid no income tax. And I think that same thing is happening today. The IRS experiences problems in dealing with transfer pricing issues. Even though they've moved to different tools, the challenges of Section 482 will remain in the foreseeable future. With global economy, why wouldn't we want to move toward a worldwide combined reporting versus what we're seeing now?
I am in violent agreement with your with your comment. I mean, I think the answer is, in a perfect world, maybe even an imperfect world, the notion that we're going to look at every separate transfer price to determine where the income is earned. I think we've learned, again, a page of history is worth a volume of logic. It doesn't work very well. I'm not saying formulary apportionment works perfectly, but I think it works better and more effectively given what's happening to the economy. And I do think it's fair to say the global community, at least, part of it, not everybody from the business community, but you look at it, there's been a recognition, given what the OECD governments, at least on the government side, that we need a better way involving perhaps formulary apportionment for at least part of the tax base to assign it, and that arm's length separate accounting, while fine for the 20th century, let's say, maybe not be the answer for the 21st.
Thank you, sir.
Yes, Mr. Kennedy.
Thank you, Professor. Relative to the erosion base that we talked about, and Mr. Wong referred to the federal government's kind of partly responding to this transferring of profits overseas and the GILTI tax. Do you know if, suppose that, excluding the way New Hampshire treats GILTI, but that there were provisions in the New Hampshire laws that basically addressed this erosion base issue or transfer pricing rules or arm's length, where they say if you're a company in New Hampshire and your costs include shipping things either overseas, expenses overseas or to another state, that we're going to do something different. And I know there's a lot of equity issues in our state constitution, but if they simply say that, let's say you can only have 5% royalties as an expense, and so we're going to decouple maybe from the regular amount. Does that create any sort of constitutional issues that you can envision if New Hampshire's decided to, instead of going to worldwide, but look for a compromise that kind of addressed this exportation of profits and simply kind of isolate it to specific things? Does that create any sort of issue?
I would say absolutely not, unless, unlike just a general approach. I mean, again, states have adopted formulary apportionment while the federal government had arm's length separate accounting, and no one suggested that the methodology, a different methodology at the subnational level, is per se inconsistent with what's going on at the national level. And indeed, the one case that might support that, the idea, a case called Japan Line, where the question of whether a property could be taxed both in the U.S. and in Japan, where it was taxed, if there's a complete inconsistency between what the states are doing and what's happening nationally, and I would say it should be subnationally, because what's going on nationally shouldn't affect what's going on subnationally. Maybe there could be, but not when the more general question you're asking is whether or not, something, whether what's some rule for assigning income or taxing income at the federal level does not in no way binds the states unless the federal government, through its legislative authority, decides that it should be. That's why we have a Commerce Clause.
Thank you very much. So there was suggestion earlier that there could be lingering Commerce Clause or even 14th Amendment issues, but none has been raised. And
I'd like to
please
respond to that.
confirm to me if this is an accurate summary of what you've told us.
It's not in my view. Again, my gold standard. I would never go near.
You
a
wouldn't
case
take it on a contingency basis.
A, because all you need for equal protection is rational basis. And
Yes.
it's certainly
And-
rational.
So I agree with you. I wanted to cut. So So as it stands in terms of the body of Supreme Court case law and the various actions of the United States Congress, there is nothing from a constitutional perspective or from a preemption perspective that currently binds our hands. The legislature of New Hampshire effectively is free to make a judgment call. Perhaps in the context of the Indiana study, we need to recognize that there are pros and cons mitigating against each other, but ultimately it's a judgment call. It's a matter of economic and tax policy.
I think that is precisely right on the assumption, again, that in the legislation, in the hypothetical legislation, there's no wrinkle that says, that provides any specific advantage. Formulary apportionment versus arm's length separate accounting, fine. But formulary apportionment that, doesn't count, out of state people, problem.
Okay, understood.
Yeah.
So we can only be so adventurous. Very good. Thank you. That was extremely thorough, very interesting, and I'm going to read a lot more carefully what you've submitted.
No, thank you very much. And I will give the links to these documents. But I think the Indiana thing was most important one there. Sorry. Thank you. Bye.
Yes, very good. Thank you.
Mr. Chair,
Yes, sir.
we've been using some jargon, and this is open to the public, so maybe we should explain what the jargon is. So if one of the accountants would like to.
Which particular jargon are
I
you?
was just thinking of guilty because New
Guilty.
Hampshire is guilty.
Global,
Unitary.
Intangible.
intangible.
Yeah, guilty is, so it's a new provision, relatively new provision
From the 2017
from 2017, okay? It's global, intangible, low taxed income. And it relates to controlled foreign corporations. So these are corporations that are owned greater than 50% by U.S. shareholders. We got a further definition here. So a U.S. shareholder is a U.S. person, which can be a company, an individual, a partnership, you name it. That's a person, right, under the tax code. In the aggregate, they have to own more than 50%. What this provision does is, to the extent that you own a controlled foreign corporation, one, you have an obligation to file a 5471. Okay, we've heard this form already. This is an informational filing that I spent this weekend working on for clients, and I wanted to put my head through the wall. It's a very long form. It can be upwards of 20, 30 pages, very robust reporting on this. And so when we talk about information being available to the New Hampshire DRA, it is important to acknowledge that these are in that file. But anyway, so we have this form, and you calculate its profits on a U.S. tax base. And that is, if it's a positive number, that's your tested income. Okay. You're also attributed a portion of kind of their assets that are used, hard assets in a trade or business, taxes. If it was a loss, it'd be a tested loss. Okay. It'd be a tested loss. I then, as a U.S. person, either the corporation, the partnership, what have you, that has these interests, aggregates all of my tested income and tested losses, and that determines what my GILTI is. Global intangible low taxed income. I'm taxed on that. That's in my tax base. And so if I own foreign corporations that are subject to transfer pricing and the separate accounting that we've heard about and all this, at the end of the day, the net of everything, at this point, the intention is gets smashed together and flows up to the owners. So as we think about that portion of the separate accounting, that's important to acknowledge. That's the intent of this GILTI provision. That's what it is in a nutshell, 2 minutes or less.
Very clear explanation. Thank you. Okay, just to preview where we're at. So we have two presenters who are both linking in through the video connection. They are scheduled for 11 and 11:30, and we're just going to make it 11:30 and noon. And I am afraid our lunch, I think, should just be cut shorter to 15 minutes. We'll take a break at 12:30, and we'll resume per the schedule at 12:45. So I'm going to invite onto the screen next Dan Bucks. He's a consultant with the Public Revenues Consulting, former director of the Montana Department of Revenue. Good morning, Mr. Bucks, and thank you for joining us.
Good morning, Mr. Chairman and
members of the commission. It's a pleasure to address you. I'm sorry that I cannot be in New Hampshire with you. I've traveled to New Hampshire to talk about these issues in the past, and I've always enjoyed the experience greatly. And I respect a great deal the kind of deliberations that you all are engaging in today. They're very thoughtful and very careful deliberations and great questions that you've been asking the prior presenters. I'm going to talk here. Hopefully, I'm not going to take the full half an hour, but much less, to basically respond to your questions and engage in a conversation with you. And again, I hope I don't eat into the time too much so that we do not have time for conversation. I'm the former director of the Montana Department of Revenue from 2004 to 2005 to 2013. I was prior to that, from 1988 up to that point, I was the executive director of the Multi-State Tax Commission. In both cases, I was the person who served the longest in each of those positions in the history of those organizations. Prior to that, I was deputy director of the Montana Department, of the same department in Montana from 1981 until 1988, when I left to be executive director of the Multi-State Tax Commission. And I was in Montana during the period of time of the intense discussions that occurred, litigation, the Worldwide Working Group, the rollback of Worldwide to Water's Edge. I was in Montana in that particular period as deputy director and heavily engaged in that. Prior to that, I worked in South Dakota, and among my work there, I advised the governor on tax policy, but I had other duties as well. But I advised the governor on the adoption of a corporate income tax at that time, which still has not been adopted in South Dakota. I also want to thank Professor Hellerstein, who preceded me here, for presenting a very thorough presentation on the history, and I'm going to refer to that. It's been very helpful here, and I'm going to refer to that in my remarks here. Let me say, out of that history, and I think the most important piece overall is that in both the container decision in 1983 and the Barclays decision in 1994, which incidentally covered two tax cases, Barclays and Colgate-Palmolive. In both of those decisions, the U.S. Supreme Court found that that worldwide combined reporting as a required method was proper and fair under the Constitution of the United States. And it applied tests, not simply of kind of legal constitutionality, but they applied the tests of fairness of taxation that the court has laid out in the 1977 complete auto transit case. And so that I think should be the touchstone of any deliberations. Worldwide combined reporting is an entirely proper and fair method of reporting. I'd also want to say, and you've had some vigorous discussion earlier on administrability, that in the Barclays case, and I'm going to skip ahead in my remarks a little bit here because I just want to make sure we get at this point. In the Barclays case, the court looked in particular at the issue of whether or not worldwide combined reporting created an excessive administrative burden. And Barclays in particular said that, it would cost them millions of dollars a year to file the returns to comply with worldwide combined reporting in California. In the end, the Supreme Court of the United States found that it would cost Barclays at the time about $900 to $1,200, $900 to $1,200, not millions of dollars, to file the required reports for worldwide combined reporting. And indeed, there was not an excessive burden, but that it was entirely administrable on the part of the company to comply with. The other thing I would note, and I was at that point in 1994, was with the Multi-State Tax Commission, and we had filed an amicus brief in support of California's position. And we had discovered on the last day when we could file the brief, and we included it into the brief, and brought to the attention of the U.S. Supreme Court that Barclays had actually entered an advanced pricing agreement with the federal government just that year, as that case was proceeding, that was premised on worldwide combined reporting formula apportionment. So the Barclays had already agreed to do worldwide reporting, had found it administrable from the standpoint of the federal taxes, but then was arguing that it was unadministrable from the standpoint of a state requirement. And the court rejected that. I urge you to read the container and the Barclays decisions. Those are the preeminent guideposts for decision-making, in my judgment, for any state, and lays out why it is proper and fair in terms of income reporting and why it is, in the case of the Barclays case, administrable. Now, worldwide combined reporting is the only method of income taxation that treats businesses of different sizes, types, and geographic scale on an absolutely equal basis. It requires all entities, again, regardless of type, regardless of size, regardless of geographic operations, to require that 100% of the income that is earned in the state, that can be reasonably assumed as being earned in the state, is reported to that state. Now, I want to just say there was criticism earlier about, oh, nobody requires mandatory worldwide reporting. That's not right. Every state in this country, to the best of my knowledge, that levies a business profits tax, a corporate income tax, a corporate franchise tax based upon income, requires the businesses that operate in their state, small businesses that operate in their state. And if they use water's edge reporting, every business that operates entirely within the boundaries of the United States to report 100% of their income to that state for tax purposes. That's mandatory worldwide reporting for small businesses, and if you're water's edge, for national businesses. The only ones that have a special privilege to not report all of their income are multinational corporations if you don't have worldwide reporting, if you don't apply the worldwide principle to them as you are requiring the worldwide principle to be applied to small and national businesses. And so I think that's important to understand, that really a water's edge report gives multinational corporations a special privilege to report less than 100% of the income that they earn in your state, and not to pay a fair share of taxes that they should for the services that they enjoy, the services that you provide that benefit them. And therefore, they're able to shift the burden of taxation from themselves to your local businesses and to the national businesses that are operating within your state. Now, it is the reason that multinational corporations don't like worldwide combined reporting is that it is the only proven and effective method for stopping the shifting of income to tax havens, to low tax jurisdictions. It is the only method that works, and the states prove that. And when they had the tax, the worldwide reporting method in effect for multinational corporations. Now, profit shifting is a huge problem in today's world, and the world, as Professor Hellerstein related to you, the world is now paying attention to it today as it never did in the 1980s. That the world is increasingly recognizing that it is a problem that needs to be addressed and is increasingly looking at formula apportionment methods. And indeed, I would say guilty for outbound transactions in the United States. Guilty is a rough form of and partial form of formula apportionment that says you have to bring back a half of your income that you shifted to low tax jurisdictions and bring it back to the United States. So the federal government has already opened the door to a formula apportionment type method on a very rough basis and much less precise and elegant than the state's formula apportionment system. And in addition, as again Professor Hellestein emphasized, that the world now, through the Organization of Economic Cooperation and Development, is now looking at formula style methods in the pillar 2, what they call pillar 2 of their deliberations, which is just a label they've applied to a set of recommendations. They recommended a global minimum tax, and on top of that, a possible compensatory tax system where if a corporation has shifted income to low tax jurisdictions, to tax havens, they must pay a compensatory tax back to the source of that income, to the nation where the income was actually earned, a tax to compensate for the profits that they shifted overseas. Now, what is that? That is nothing more than a form of worldwide combined reporting operating not at the taxable income level of a return, but at the tax liability level. Now, some business organization representatives say, oh, the OECD has rejected worldwide unitary. Well, that's because the OECD spent several decades denouncing worldwide unitary as practiced by states until they realized that their arm's length system was an abject failure. And now they're moving towards, in fact, formula apportionment methods. And they don't want to say directly and lose face by saying, oh, we're going to do what the states in the United States did. Instead, we'll do something else. But that something else is the same thing in a different form. It operates, a compensatory tax system operates with worldwide calculations at the tax liability level instead of the taxable income level. So they're saving face. And when you hear that they've rejected it, that's not true. Because in fact, as the professor before me indicated, they are in fact seriously considering moving in that particular direction. The arm's length method of accounting for tax purposes is essentially dying and is judged as a failure because of the massive nature of the profit shifting that has occurred. Now, I'm going to try to short circuit my comments here a little bit, but just talk about the nature, the extent of the profit shifting that is occurring in the world and the size of the inequity that is occurring. We don't know exactly what it is because there's not sufficient disclosure required of tax return information to do an exact calculation, although I'm going to cite some that is beginning to come out from tax disputes and that have been studied here in a minute. The Congressional Budget Office has estimated that $300 billion in profit is shifted annually to other jurisdictions where it goes untaxed, and that correcting that would amount to about $60 billion a year in federal revenue, and if you extrapolate that to the states, that would be about $12 billion in state taxes annually. That's on the low side estimates. Other organizations have estimated that it's up to nearly $180 billion in federal taxes lost, with a much larger part, accordingly, being lost to the states. No, so along comes some business organizations who say, well, because no one can agree on what the number is, there really isn't a problem. Those are not reliable estimates. Well, they're not as reliable as we'd like them to be because the tax returns have not been sufficiently disclosed to do a precise calculation, at least on a general basis. But that is changing. Australia is now requiring company by company reporting. The Financial Accounting Standards Board is requiring increased disclosure of tax information, and in addition, some enterprising tax economists and accountants of international standing have begun to calculate from tax dispute data the extent of the problem. And I commend to you an article by Ruben Albiona, David Chamberlain, Stephen Curtis, and Jeffrey Cadet in Tax Notes Federal of May 22nd, 2023, in which they indicate, and they add to this tax penalties and interest, and I'm not, that a set of 6 companies, and they're named in the report, over a multi-year period, avoided $277 billion in federal taxes. And those are, a portion of those taxes were avoided in New Hampshire, incidentally, and not successfully returned to your state, at least not yet. So the problem is huge. And when the business community says, well, they can't agree on the estimates, all the estimates are from the range of being an enormous problem to being a catastrophically enormous problem. And so somewhere in between enormous and catastrophically enormous problem is the problem that you face and that I would urge you to solve with the adoption of worldwide unitary. Finally, I'm just going to say this as a general matter so that you have time for questions. I presided over the administration of worldwide taxes, worldwide reporting taxes in Montana. We were still having remaining audits when I was executive director of the Multi-State Tax Commission that covered worldwide reporting years for states when I was head of the Multi-State Tax Commission, and we were auditing corporations at that time. And again, when I was Director of Revenue Montana in the most recent period of 2005 to 2013, we had a tax haven statute that combined tax haven income into the tax returns at that particular point in time. And in all of those cases, those laws, those worldwide and tax haven laws, were entirely administrable and readily administrable. While there is information from federal tax returns that is helpful and from state returns that is helpful, the fact is, and you had these earlier questions about, is there information on those returns to enable you to do the worldwide reporting? The answer is not entirely, but the information is there in the public financial reporting of the companies that is utilized for this purposes. And some of the smallest states in the country, including New Hampshire, North Dakota, Montana, and Alaska, which incidentally requires worldwide reporting for oil companies still to this day. Some of the smallest states in this country successfully administered the worldwide system and successfully audited corporations for that purposes over a long period of years. California began worldwide combined reporting. Their first case of that was in 1939, and it was entirely administrable. And I'm just going to stop there and say simply again that the operative words are from the U.S. Supreme Court. Worldwide combined reporting is proper and fair for the states to employ to do justice to their citizens. Every other taxpayer has to report 100% of their income, and so should multinational corporations. Thank you, Mr. Chairman, members of the commission. I'm going to stop there. I have a lot of things I'd like to say about the Worldwide Working Group report, et cetera, but you can just ask me questions and I'll try to be as responsive and as helpful as I can be. Thank you.
Thank you very much. And I don't know that I have it yet, so if you could send us the link for the tax notes article that you mentioned, that would be helpful.
Yes, yes, I will. I apologize for not having submitted that earlier.
Okay. Questions from the panel? Mr. Kennedy.
A couple quick questions regarding the opposition to worldwide reporting. So it appears clear based on your testimony that the state certainly could move to worldwide reporting without suits, or I mean, there might be suits anyway, but they'd have a good premise from the Supreme Court that they're allowed to move to that. But this might open up the gate for other suits, like what entities should be included? How do you apportion income? What about aggregation of ownership? And so this could lead to additional costs for companies and the state when these sorts of disputes come up by moving to worldwide reporting. So I'm curious as to what kind of response you have to that. And the second to that is another opposition is that foreign entities will, the word that's been used today is will retaliate, or perhaps the state will lose business because worldwide reporting would mean international companies would no longer do business in New Hampshire. So I'm curious as to what your thoughts and response are to those opposition points.
Yes. And when I was saying that the tax was administrable, I was including within that a judgment as to the determination of the Unitary Business Group, because that is the beginning point with regard to any kind of combined reporting. We did that. We did that successfully in the 70s and 80s in a wide range of states, or in a dozen states, including, again, the smallest states in the country. There is no record of inordinate disputes in those small states over the composition of the unitary groups. We did not have any more difficulty with regard to multinational as opposed to nationally based companies or foreign corporations versus U.S. multinationals. To my knowledge, that's the best of my recollection, because we just did not have inordinate cases. California did some rather sophisticated methods late in the stage of their practices of decombining, et cetera. Some of the rest of us thought that they were getting a little bit fancy at that time. That was more of a variation of that time that I think was not necessarily consistent with the longer term practices that both that state and the smaller states had engaged in. And that was, I think, was an idiosyncratic kind of situation that arose late in the process of their use of combined reporting. And I don't think that was typical. We had no greater difficulty applying the unitary principle to foreign multinationals than we did to U.S. multinationals or to national companies operating within the United States. As to retaliation, the last slide that Professor Hellerstein had up referred to the fact that the states receded. It was not a pretty picture in the 1980s. When the states were receded from water's edge, they were threatened with economic damage by foreign corporations, saying, we will not invest in your states anymore if you don't repeal water's edge. Now, I will give you the term that I apply to it. Others would find it too strong, but I considered that. I was present when that message was issued to the Montana legislature, and I was representing the department as deputy director on legislative relations. I considered that then, and I consider it now, to have been economic blackmail. And let me give you evidence of that. I was referred the letter that came to the governor of the state at that time, that came from the Mr. Akio Morita, the head of the Sony Corporation. And he was also writing on behalf of the Japanese Business Federation, which is, I've got the Kadanran, the Kaidanren, I may not be pronouncing that right, but that's the Japanese Business Federation. And he wrote this letter that said basically that if you do not repeal worldwide unitary and adopt water's edge reporting instead, you will not get any new investment from Japanese companies in your state. But the implication was if you did repeal it, you would get investments. So they laid out the prospect of computer chip plants and high-tech electronics plants of other kinds and automobile plants that would arrive in our state if only we would repeal worldwide unitary. And under the threat of no investment from those Japanese companies, the state of Montana, the legislature, receded to the water's edge as they had urged. Well, it's 35 years later. We're still waiting for those computer chip factories. We're still waiting for those automobile plants. They never came. That was a phony threat. It was a despicable campaign that was undertaken against an entirely constitutional, proper, and fair practice of the states that only asks a multinational corporation to pay taxes on the same basis as a small business in a state, as a national business in pays taxes in a water's edge combined reporting state. It only requires equal compliance is all it does. And to say that you won't get any investment for treating the company in the same way that every other business is treated is, in my judgment, reprehensible. Thank you for the question.
Yes, Representative Ullery.
Yeah, Jordan Ullery from Hudson, New Hampshire. I've asked this question of others. You've probably heard it regarding a company, an international company in New Hampshire with a loss overseas, and then just transferring the profits over there and showing a business loss, therefore not having to pay any taxes at all under either business profits tax or being then subject only to our business enterprise tax, which is a tax on hiring people for some reason. How would New Hampshire benefit from a worldwide unitary taxation if a business can just write off their profits to another division?
Well, Mr. Chairman, Commission member, I'm sorry,
Ullery,
thank you. The answer is this: is that if you have a business that is truly losing money, in terms of if they're conducting a unitary business in your state, be it onshore or offshore, and they're truly losing money in total on a real true basis, yes, they will not pay taxes in your state in that particular year. That's true, because they are actually truly losing money. But and that's fair in that instance that I'm talking about. And if that is truly the case, but what the reality is that and the reason why there's a revenue gain, and the reason why there will not be revenue volatility, is that is not the typical circumstance that is occurring. What is happening right now is that states that multinationals, both U.S. and foreign multinationals, are generating artificial losses, deductions against their U.S. income by shifting profits overseas through various mechanisms. Sometimes they involve intangibles, sometimes they involve other mechanisms, to tax havens. And those are artificial losses that are being deducted against your tax returns today. And what combined reporting does is end the fictional losses and brings that money back into the worldwide group and makes it taxable. You're not going to have a massive loss of revenue because of the situation that you've just described. Businesses go up and down, they have profits and losses. That's the normal. That normal business activity is not going to generate overwhelming losses in a given state. What is generating overwhelming losses right now is the artificial shifting of profits that they are earning in New Hampshire right now, and they're shifting it overseas and into tax havens. And what worldwide combined reporting does is it puts an end to that profit shifting. And you will have a net. I don't recommend this on the basis that you're trying to gain more revenue. You're only trying to tax the revenue that you should fairly tax. And when you do that in the context of the extensive unacceptable profit shifting that is occurring, artificial profit shifting that is occurring overseas, there will be a revenue gain produced, and there will be an anchor to your revenues that decrease the revenue, the effect of any revenue volatility because of the normal business cycle. The profits that are being stashed overseas and hidden from taxation are enormous, and it's a practice that needs to be stopped, and I urge you to do so.
All right. Thank you very much, Mr. Bucks. We have one further presenter before we take our brief break. And
Okay.
Darian.
Thank you very much.
Thank you very much. Darian Shansky, Martin Luther King Jr. Professor of Law, UC Davis School of Law. And Mr. Shansky, much like Mr. Bucks, has been a previous flyer with the New Hampshire legislature and provided advice. So welcome back again, even though your last visit was preceding me.
Well, it's great to be back. Having grown up on the East Coast and been to New Hampshire, I missed the fall, and I would wish I were there in person. Can I share some slides? Is that how Professor Hellerstein did it?
Yes, you can.
Okay, do you guys see slides?
Yes.
We do.
You do? Oh, terrific.
We've got a small image of you in the upper left and a prominent image. We also have a copy of your slides in front of us.
Oh, you do? Okay, terrific. Okay, so yeah, I apologize. My only issue is I'm not seeing the slides myself, so I don't, but I will just begin and move them knowing where I'm at, and hopefully you'll let me know. So it's an honor to be here. I will go quickly. I tried to come up with an agenda that reflects the fact that I knew I'd be following people who were going to say a lot of other things. I still managed to duplicate a lot of what you've said. It's been said already, so I want to leave as much time as possible to answer questions. So I want to talk a little bit about New Hampshire, which most of course you know, a little bit about profit shifting, about the policy behind worldwide combination, and then mostly focus on responses to objections. Okay, so do you see the slide about New Hampshire expenditures? Is that what, am I on sync?
You're on the caption page, short case for WWCR.
Oh, okay, hold on.
Sounds like you want to move ahead too.
Right. Sorry, I'm just having a problem here, and I'm just embarrassed at this point in our virtual world that I'm not able to operate Teams effectively. Hold on one second.
I'll tell you what, I would suggest just go ahead because we do have.
Just go ahead. Yeah,
printed.
I'm between you and lunch, and that's not a good situation for anybody. Um, okay, so you have the slides in front of you, so I'll just go quickly. So I have some information just about New Hampshire expenditures and revenues from the Urban Institute, from a high-quality report. A lot of these reports are not that high quality, but the Urban Institute is, showing New Hampshire is, slightly below average both in taxes and revenues. More interesting, if you look at the chart on the third page, is it actually shows that New Hampshire, in terms of its fiscal capacity, doesn't raise nearly as much as it might. So New Hampshire's not really a low tax state, but it is a frugal state, right? One that punches above its weight, and something that I presume you'd like to continue. New Hampshire's state taxes, as I know you've already talked about, this is the next slide, has an unusual tax structure, right? There's no general personal income tax. There's no general sales tax. What New Hampshire does have is the business profits tax, the business entities tax, and New Hampshire raises twice the national average from its property tax. The next slide is from your consolidated financial statements showing that the BPT raises, something on the order of $700 million, and as you know, is the largest single revenue source for the state. It's also, the next slide, the best designed corporate income tax in the country, in part because it's the only corporate income tax that doesn't just tax corporations. There's no reason to not tax large businesses the same as corporations. I tell that to other state legislatures all around the country and have had no success. But you are doing the right thing. New Hampshire's business enterprise tax is an addition method subnational value added tax, which is also terrific, and I talk about across the country. And so in lots of ways, New Hampshire has gone its own way wisely in order to raise money efficiently. So I think that's, at least for me, important context in terms of what we're talking about. Next slide, I talk a little bit about what profit shifting is. I know this has been addressed. There are questions, right? How does money get abroad? And the answer is corporation with operations abroad. This is a simple example, can shift their intellectual property to a low tax jurisdiction. The low tax jurisdiction charges royalties, and profits are out of the US tax base and into a foreign tax haven. Now the question is, right, how big is the problem? Including how big is the problem now after the Tax Cuts and Jobs Act, to the extent people perceive that act had provisions meant to counter tax shifting. And so this is the next slide. So the current estimate is that it's about 300 billion. And that's, again, current, right? So this is not historic. So this is despite the Tax Cuts and Jobs Act. Now the question is then, well, how much would that mean? For instance, if that money were brought back into the tax base, how much could that raise for New Hampshire? The back of the envelope calculation, just working backwards as to how much the percentage of New Hampshire's tax base would increase, gives us a number around $140 million per year, which I think, not surprisingly, is about the same rough estimate as the ITEP study arrived at. Again, this is all back of the envelope. I'm just providing this to you so you understand that these are reasonable estimates. Your question arose, well, shouldn't the IRS be doing something about this $300 million leaving the U.S. tax base? Yes, they are failing. And of course, it's not just the U.S. National Tax Authority that's failing. That's why the whole OECD is a flutter about this issue. But yes, they should, but they're not. Next slide, I have a couple of pictures just to show what tax shifting looks like. It means, and if you look at the first picture, that in this case, U.S. multinationals are booking enormous profits in a handful of low tax jurisdictions. And the profits are out of all proportion to the assets in those jurisdictions. If you go to the next slide called more evocative, that slide shows, for instance, that U.S. multinationals book profits in foreign jurisdictions that are multiples of those entire countries' GDPs. And what that illustrates, right, is that it's clearly impossible for foreign corporations to be having profits larger than the entire gross domestic product of the jurisdiction in which those profits are booked. Final table, it's called Picture of Opportunity, shows a slide that about the percentage of business profits that are actually being successfully taxed. And you'll see it's a sad number, right, that the federal government isn't doing very well and the states are doing even worse. I call it a picture of opportunity because it also indicates that if states only do as well as they did in 1993, that would be a gigantic increase to their corporate tax base. Okay, so now to think about some objections, one common one, right, is, well, nobody else is doing it. And so the next slide is a quote from Charles McClure, who's in many ways the preeminent tax economist of last decades. And I've heard him use this analogy many times in connection with trying to get states to do the right thing about the sales tax, totally different issue. And his point, right, is that just because inexplicably every other state is doing something foolish doesn't mean that you should as well. And I would think, again, going back to our introduction, this argument should be particularly appealing in New Hampshire, where you've already demonstrated some interest in not just doing the same foolish thing that every other state is doing. We need to ask, right, not what every other state is doing, but whether this makes sense. So if you go to the next slide, there's a picture of a building from England, and it has the strange characteristic, and if this were a law school class, I'd really draw this out, but I'm not going to waste your time, that it's a picture of a building with blocked windows. And, you don't need to know a lot about England to know that doesn't make a lot of sense to build a building and then not have windows. And the question is why? And the answer is that King William III thought it would be a good idea to impose a tax on windows. And his theory, and if you've watched Downton Abbey, you know it's not a crazy theory, rich people have more windows. It's easy to walk around and count the windows. It seemed like a good idea for a tax. But the problem is, as obvious, people don't like paying taxes, and they will engage in crazy behavior in order to avoid them, which is why the first principle of sound tax policy is to have as broad a base as possible. And the problem with having a water's edge regime is you're basically inviting these multinational corporations to shift income out, right? It just violates the basics of tax policy, not to tax as broad a base as possible. So next slide. Well, maybe it's just common sense policy, but won't all the businesses leave? Important to talk about this, and I know it's been addressed already, but just to be clear, New Hampshire imposes its business profits tax not based on physical presence, but on economic activity in the state. New Hampshire currently apportions the business profits tax based on sales, not based on property or payroll in the state. And so there's no real economic thing that a big multinational taxpayer can do to avoid paying these taxes other than stop making profitable sales in the state. Okay, next slide is an excerpt from a blog post, which you might have seen from the Tax Foundation, talking about what a huge burden worldwide combined reporting would be. And I just wanted to pick apart this slide, just the argument just a little bit. Right. First of all, there's a claim, right, that there's a massive increase in compliance burden, with unsighted, no support. And the description is, well, look, here's what you're going to have to do. You're going to have to combine all these different international accounting rules, and you're going to have to do it and bring it into line with how New Hampshire would do it. Sounds pretty bad. Sounds pretty burdensome. And on top of that, there are all these other things you're going to have to keep track of, like payroll, which you wouldn't have to do. But of course, we just talked about that New Hampshire uses the sales factor. So actually, all you have to do is keep track of sales. If you go to the next slide, I'm going to try to provide you some evidence, such as there is, about compliance costs, because the argument was already made in the context of the Barclays case that worldwide combined reporting is burdensome. That argument was subjected to a trial, and actually the Supreme Court in Barclays cites the lower courts in California's findings that the cost was not very significant. Right? That's the next slide, the cite from Barclays. The Supreme Court, if you go to the next slide, titled also explains why that's so. The reason is that the California regulations permitted reasonable approximations. of foreign income and sales, and those days the other factors, and didn't require all these sort of crazy transfer of foreign income practices into California practices. Important point, California did give up mandatory worldwide combined reporting since in 1987. However, California's new situation is, or new since 1987 is, worldwide combined reporting is still the default rule, and corporations can choose a water's edge election. That means these regulations are still in effect, and that means that many taxpayers, particularly taxpayers who have losses abroad and want to take advantage of that and will benefit from worldwide combined reporting, have been filing using the worldwide combined reporting method continuously over the preceding decades and has been administered by the Franchise Tax Board. And if you go down this route, and I would recommend having your department contact the Franchise Tax Board about how they've been able to administer the tax. And I will just say, because I can't speak formally about this, that they have not had a lot of difficulty, consistent with what Dan Bucks just told you. But ask for yourselves. So go to the next slide, right? More fundamentally, it just doesn't make a lot of sense for these large multinational corporations to say it's just too hard to figure out what their income is or where their sales are. Interestingly and importantly, perhaps, and if you're really worried about this compliance issue, for purposes of the new corporate alternative minimum tax, the largest taxpayers are going to have to use financial statement income, including of their foreign subsidiaries, to create an aggregate picture of the financial of the income of the whole group. And so if the concern is that this would be too burdensome for smaller taxpayers, then just say, if you're subject to the corporate alternative minimum tax, then you have to file on a worldwide basis because you're already doing something very similar at the federal level. If you go to the next slide, titled Really, right, that's just, again, I'm trying to provide you with evidence. Here's an example from Amazon's annual report where it's breaking out sales by geographic location. And that's basically all we need to know, right? Once we know Amazon sales in the US, now you can just break it down in terms of New Hampshire, right? So it's already out there as a matter of financial accounting and compliance with the securities laws for many of these countries. Again, this is just repeating what Professor Hellerstein just talked about. If you go to the rest of the world, couple of points, right? The notion that the base erosion is a problem, right? It's not just something that a handful of people have noticed and perceived as a problem of both fairness and a drag in some ways on the whole international economy and tax system. It's a big issue at the OECD. Both Pillar 1 and Pillar 2 have worldwide and formulary components. Let's go to the next slide. And it makes sense, right? So if you're concerned about a big multinational company paying a 15% minimum tax, that's Pillar 2, then you need to know what's in the group and what's not in the group. So that's just worldwide combined reporting. And if you go to the next slide, here is an excerpt from the OECD rules, at least current proposed rules relating to Pillar 2, again, requiring a kind of consolidation. Final critique that I will address before stopping for questions, right? Again, quoting the Tax Foundation, this is the slide, but there's no money there. The idea is that the ITEP estimate of 177 million is totally unsound. The argument is that it's unsound because it doesn't take into account that you have to reduce New Hampshire's apportionment percentage as well. And the critique is itself unsound because the whole premise is that this is income that's been shifted out. And so there's no reason to dilute the state factors and taking it into account how much the state would raise if the income were added back in. It is true, if New Hampshire goes to worldwide combined reporting, that there would be dilution of New Hampshire's factors, and there would be some winners and losers. and some corporations that have big losses might pay less than they currently pay, but that's entirely appropriate. And on balance, again, as Dan Bucks explained, because of the significance of income shifting, it's very likely New Hampshire would come out ahead. There was a question raised about the interaction with GILTI, a federal provision that on a limited, slightly different way brings back some presumed shifted income. It is a good thing that New Hampshire conforms to GILTI. The interaction between worldwide combined reporting and GILTI is complicated. It probably means that the amount that New Hampshire would gain is somewhat less than the current estimates, whatever they might be, because New Hampshire is getting some of that income back in its basis, in its tax base through GILTI. It's very hard to say exactly how much. I have, some rough intuitions about it that I'd be happy to talk more about or talk to the revenue authorities about. Final slide, upshots. No state has as much to gain from getting their business taxation right as New Hampshire. The primary arguments for worldwide combined reporting are that it's efficient and fair. It also turns out that it's likely to raise revenue, but you could use that revenue obviously as you want. You could use it to reduce some less efficient tax. You could use it to help address the issue with property tax equalization that I know is an issue in New Hampshire. Fun sidebar, Texas has something called a margin tax, which is a less good mashup of your business enterprise tax and your business profits tax that everybody hates. Why does Texas have this tax? It has this tax to address property tax equalization issues. So, just an interesting way these things go. And then finally, I just wanted to just make myself available as things progress. I'm happy to be a resource in the future about any questions. And the final slide just has some additional sources that you can refer to. So that's it. Happy to take questions.
Excellent. Thank you. Very useful slides. The version we have are kind of microscopic, but Jen, we'll get these as a computer link.
Sorry.
So we'll have the luxury of looking at them in a large format at home. They were readable, but there were some I had to really squint at. Okay, questions from our members? I'll just ask one. So if I understand, you're saying in effect the GILTI is effectively like a partial implementation already in place, and therefore mitigates the potential to gain, but maybe also illustrates where the potential is.
Yes, that's right. I mean, it illustrates that it's a big problem that the international community and the federal government is dealing with. It also illustrates that these big taxpayers are already calculating the foreign income of their subsidiaries for purposes of GILTI. Not exactly the same calculation, but clearly they're already playing in this sandbox. And so it's not a big deal, I don't think, reasonably to say it would be overly burdensome. And yes, in terms of revenue estimates, it's something to keep in mind. I mean, I suspect you are making a reasonable, you are drawing a non-trivial amount of this income back through GILTI, but not as much as you would do through worldwide combined reporting.
Understood. One further question. In a prior slide, you referred to one of the elements of the Supreme Court's Barkley decision.
Yeah.
Was that they, if I understood this, they took note of the California regulations, use of the term reasonable approximations, and they blessed that. So effectively, aren't you essentially endorsing the idea that any action by the state of New Hampshire and its subsequent regulations would allow for reasonable approximations? That it's a policy choice that would make the statute more workable?
Yes. Yeah, I mean, certainly as a matter of federal constitutional law, New Hampshire has a huge amount of latitude. I think it could probably have something stricter than California had. But California had reasonable approximation. It was an issue in the case because the taxpayers insisted that the worldwide combined reporting was too burdensome. So there was actually evidence taken about this. And this is a time, right, where California was also asking for foreign property and payroll. This was obviously a time when, you know, computing was not what it is today. And still, the court found, upon actually looking at evidence, that for a big corporation like Barclays, it wasn't such a big deal. So I'm not telling New Hampshire exactly how to approach, combining these foreign corporations. I think adopting the California approach as both blessed by the Supreme Court and as a methodology that clearly works, and that these big businesses are familiar with how to use in California and will use when it's to their benefit, would be the way to go.
Representative Shambert.
Thank you, Mr. Chairman. On slide 21, where it says really,
Yeah.
what you're saying is that, is it all public or is it all private corporations that have to file this?
So I should just caveat, right, I'm not sort of a professor of accounting. So my understanding is that this would be for public corporations. I know that certainly to be governed by FASB and the SEC. I don't want to speculate exactly on how it would work for a private entity, although again, it would be pretty stunning, right, if big investors in private entities were willing to like not get something right analogous. But I don't want to speculate about that.
I should have asked my two gentlemen to the left of me for that question, but I was hoping to get it.
Yeah,
from-
it's
Chance to do that next Monday.
well, this is just corporate alternative minimum tax as a barometer, and happily I've forgotten the threshold for it because my clients are not in that base. But it's only like a couple hundred companies that are going to be subject to this as it's been rolled out. Someone else in the crowd may know better on the threshold, but it's only going to apply to a very small subset of businesses based on billions of book income, based on kind of governed, public accounting standards, what have you.
Thank you.
Yep.
Yeah, that's true. I can't speak to the exact universe, but it's a relatively small number of companies. But the overlap between those companies and the supernormal profits and income shifting is very, very high. So someone would have to do the estimates. And I'm not necessarily, again, I don't think it's burdens. This means, I'm not necessarily saying that this is something, a compliance burden that smaller companies couldn't handle just fine. But if the concern is that you have to start somewhere, and which companies, right, can most clearly handle it because they're doing something similar, and which companies have the biggest potential to shift profits, these are those same companies.
Okay. All right. Thank you very, very much. I appreciate your patience in waiting your turn. So the commission will take a brief 10-minute or so break. And yes, I'm going to basically postpone lunch. And so we'll proceed. Carl Frieden, I believe, is here in the room. Thank you for your patience. If we're a couple of minutes past 12:45, I think we're good. Okay, so we're in recess briefly.
Thank you.
I'm going to call the commission's meeting back into session. It's 12:51, and I hope everybody got at least an energy bar or something along those lines. Um, multiple forms of energy, including chocolate. So I'd like to welcome our next presenter, Carl Frieden, Vice President and General Counsel, the Council on State Taxation, otherwise known as COST.
You want to push your button on your.
Like that? You want to actually hear me as opposed to see me?
That's a compliment.
To start again, Chairman Spilsbury and members of the commission, my name is Carl Frieden, and I'm Vice President and General Counsel of the Council on State Taxation. And just by way of a little bit of background, COST is a nonprofit trade association consisting of about 500 multi-state corporations engaged in interstate and international business. You can pretty much think of, 500 of the largest 1,000 companies in the world. Our objective is both education and advocacy efforts, to preserve and promote what we consider to be equitable, balanced, and non-discriminatory state and local taxation of multi-jurisdictional businesses. We generally, and this is an important point, we generally don't weigh in on things like tax rates or how much you want to raise in taxes. Those are, your sovereign decisions. But we do weigh in on issues like worldwide combined reporting that we think are bad tax policy, a bad design, as I'll explain, both unfair, overly complex, and potentially discriminatory against multi-jurisdictional businesses, depending on the way they're done. I've got 5 slides there that I think will kind of give our perspective, the business perspective, you might say, on why New Hampshire. And I'm going to really focus on New Hampshire. There's a much broader debate around the world on what the world should do with multinationals, now they should tax them, but why New Hampshire should not adopt mandatory worldwide combined reporting, I think, is the issue in this hearing, not what other states should do or not. And so I'm going to really zone in on that. A few of the speakers did drill down on a couple elements of New Hampshire, but I'm going to go much further to show, why your current tax structure is one that doesn't require worldwide combined reporting. But as an overview, before I get into those 5 slides, just as I listened today, what I heard was sort of the following from the 3 proponents of worldwide combined reporting. 1, worldwide combined reporting is constitutional. 2, there's widespread international profit shifting by multinational companies that deprives New Hampshire of its appropriate share of corporate tax revenues. 3, worldwide combined reporting is the best, perhaps the only method for addressing this and getting the appropriate foreign source income into the New Hampshire business profits tax base. 4, worldwide combined reporting is manageable. I think Dan Buck said it's only $900 or $1,000 a year to file for it, according to the Barclays case. And 5, and I think this is a really important underlying issue here, which is that implicitly, and this is from the proponent's perspective, corporations aren't paying their fair share of taxes in New Hampshire, and this would be one way to address that as well. So let me, before I go into my slides, which I will do sort of quickly, but and these are leave behinds and drill down on some of the points I'm going to make. Let me respond somewhat succinctly to those 5 points, and then I'll drill down on with some details there. First of all, yeah, of course, worldwide combined reporting, as long as it's appropriately structured, is constitutional. The Supreme Court said it twice. We have no disagreement there. We do have a disagreement as to just because something's constitutional doesn't mean it's the right tax policy. And I think Dan Bucks went quite a little overboard in suggesting almost an endorsement by the U.S. Supreme Court of worldwide combined reporting. What they said in Container and Barclays was it was constitutional. It was a method the states could use as long as others. They never endorsed it. It was the method or the fairest method. They never said anything like that. But there's lots of things that are constitutional that you wouldn't necessarily want to do. You could double your business profits tax rate right now. That's constitutional, but I'm certainly not suggesting you do that. So that's the first point. We agree on the first point. The second point is a very important one, that there's extensive profit shifting that's depriving New Hampshire of its revenues. And I'm going to kind of combine the second point and the third one I'm going to make. And there's certainly, there can be no question that, I mean, I think the OECD, the federal government with guilty, there's a lot of nations around the world, not just states, that are focused on how to appropriately tax global companies that have operations in all over. And it's gotten much more complicated with intangibles, which are easier to move perhaps than people. So there's no question that there is some level of profit shifting, and it's being dealt with at a global basis. There's a huge dispute as to how much, and some of these numbers cited, like the 177 million that New Hampshire would somehow magically get if it could address this profit shifting, or, in my mind, incredibly, almost preposterous numbers. And I could certainly provide you, but there have been a number of critiques of some of the underlying data suggesting that some of the data that those numbers are based off, for instance, are, exaggerated by 2/3 or more. But there is a debate, as one of the earlier speakers said. It's not exact, but there clearly is profit shifting. The problem I have with the ITEP numbers, and they were cited in different forms here, I have a much bigger problem than sort of the underlying estimates as to how much profit shifting there is, 4% or 10% or 30% or whatever. The bigger problem is ITEP, in all of its numbers, doesn't take into account what a state is currently doing in terms of taxing foreign source income. So the assumption in the ITEP numbers is that they're not taxing foreign source income, and all of this would come in. And that's particularly misleading notions, especially given New Hampshire. And when I get to it in a minute in the slides, New Hampshire currently is taxing most or all foreign source income. New Hampshire is taxing more foreign source income right now than any other state other than Vermont. And I'll go into this in a little more detail. It's taxing more foreign source income than the federal government. And even though it's a little bit of an apples and oranges comparison, arguably it's taxing more foreign source income than any government in the world right now is taxing of its multinationals. So somehow this notion that you'd get $177 million because you're not taxing foreign source income ignores a very salient fact, which is you actually have most, if not all, and it's, it depends on the company, but most, if not all, on either a current or deferred basis of the foreign source income in your tax base. So you don't need to do this at all if that's your concern, if there's some huge tax gap. I'll also comment, briefly on the complexity of it. And, there's no question that companies can do worldwide. Some of them, as one of the speakers mentioned, are doing it on an elective basis. It was done in the past, for 20 or 30 or 40 years. It's not that they can't do it, but it is quite a bit more complicated. And I'll provide a little bit overview of that. And then the final point I'm going to make, which is I think a really important one for New Hampshire, is ultimately behind all of this is that business is not paying their fair share. And it's really interesting, and I didn't submit it yet, but I will send in, there's a study that Ernst & Young does for cost every year, which is called Total State and Local Business Taxes. It has estimates for each state on how you compare to the other states. And just some quick ones here, which I think show that business is paying more than their fair share of taxes compared to other states. And this is because of your unique tax structure. I mean, you don't have a sales tax, you don't have a personal income tax, so it's not surprising you're collecting more from business. But if you just want to look at the overall stats, on a national average, business pays about 43.7% of all state and local taxes. In New Hampshire, it's 47.9%. And I'll send this report to you. But much more importantly, for your purposes, because you're concerned with state taxes, at the state level, the difference is even greater. New Hampshire is the third highest proportion of all their state taxes that comes from business, 62.7%, compared to a national average of 37.8%. The only two states higher than you are Alaska and Wyoming, which are heavily dependent upon oil revenues, not surprisingly. And it's, again, because of the importance of the business profit tax and the business enterprise the tax. These shouldn't be surprising, but they're still relevant. And that's collecting from both small and big business. But business pays a very large share of the tax base already in New Hampshire, much larger, certainly at the state level, than almost any other state. And if you break it down by, you're number one in terms of a corporate excise tax as a percentage of overall taxes, your business profits tax, or as a percentage of just taxes a business pays, you're number one in the country on both of them. So this is not a tax. My point being that compared to other states, you're underutilizing, you're, if anything, overutilizing it. So let me just get into the charts here because I want to drill down on a couple of those points, and then I'd love to entertain questions. And I'll try to respond to, there were just so many different comments made. I can't possibly respond to them all, but let me try to respond to the ones I think are more important. This is a chart of which states tax. The two major sources of foreign income tax by states now are GILTI. Rough justice, you can think of it as something the federal government started doing in 2018. It's taxing on a current basis 50% in some states, much less in others, but it's sort of like roughly 50% of all of your global income, less an amount that allows you a return on investment. And you could go into the formula if you want, but basically for a lot of companies, it's 50% of their global income is what's in the New Hampshire tax base and what's in the federal tax base. That's one method of taxing foreign income that just started 4 or 5 years ago. New Hampshire is following the federal method of taxing 50% of that. New Hampshire also taxes 100% of Subpart F, which is another thing the federal government does, which is a smaller category of a sort of a passive type of income earned abroad. But really importantly, the federal government for 90 years used to tax 100% of foreign dividends. So they would tax all foreign income, less what was taxed abroad, but on a deferred basis only when you dividended it back. They stopped doing that in 2017. New Hampshire is one of only 3 states that taxes that at 50% or above. Vermont and New Hampshire, and Vermont and New Hampshire tax at 100%, and Minnesota at 50%. So just to sum up the bidding here, you've got a state that's now taxing roughly 50% between Subpart F and GILTI, roughly 50% of foreign income on a current basis, less a certain amount for some companies as a return on investment. And then what you don't tax, most, if not all of that, comes in later when you tax the dividends that get distributed back. Now, in the past, the dividends didn't necessarily used to get distributed back because there was a federal tax on those dividends, and companies kind of held on to it. Now there's much less incentive because the federal government doesn't tax that anymore. So that's why New Hampshire's taxing more now than the federal government, because you're using their own old system of taxing 100% of residual foreign income when it gets distributed to shareholders, and you're taxing 50% of Subpart F and 50% of GILTI. When you look at this chart, the companies in the states in light blue, which is a majority of the states, don't tax any foreign source income. And that's some of the largest states in the country. Now, you can question their decision or not. They're certainly aware of all these discussions that we're having today on, profit shifting and all that, but more than half the states don't tax any foreign source income. A smattering of the states tax 20 or 30% of GILTI. California has a special method where they tax 25% of foreign dividends, but none of GILTI. Minnesota now is a new state that sort of taxes 50% of foreign dividends and 50% of dividend of GILTI. But basically, Vermont and New Hampshire are alone among all the states in taxing as much foreign income as they're talking about. So when you talk about profit shifting, and this is where this all comes together, the purpose of worldwide combined reporting is on the premise that there's a lot of profit shifting, and the only way you can accurately measure how much New Hampshire should get as its fair share is to bring in that foreign income. My point here is that either on a current or a deferred basis, New Hampshire is bringing in most, for many companies, all of that foreign income, and certainly more than any other state, and certainly more than the federal government. So this so-called tax gap here that needs to be addressed by worldwide combined reporting, if any state didn't need to do something about it, it's your state. And to his credit, Darian Shansky mentioned that a little bit, although he just mentioned GILTI, and the chair had a good question on that. But the full scope of what you're taxing, and the reason being is that even when you dropped worldwide combined reporting in 1986, you immediately started taxing 100% of foreign dividends, which is what the federal government had been doing historically. and which very few states ever did. I mean, even back then, very few states ever followed the federal model. So it's not as if you ever sort of ignored this, even when you transitioned in '86 from worldwide to water's edge. You still have been, since that day, taxing 100% of foreign dividends. In 2019, effective for 2020, you added in guilty without taking away, as all the other states pretty much, except for one, did when they got rid of foreign dividend. You know, when they got guilty, they got rid of the foreign dividend. So you're taxing it two different ways. And that it's nothing unconstitutional about that. It's just you're covering it two different ways when, you know, almost no one else is. So that's kind of the importance of that chart. Is it doesn't mean that, you know, you couldn't or shouldn't consider worldwide, but it does mean that the problem that is all the proponents keep saying you need worldwide combined reporting from, all this profit shifting and all this, these big guys getting away with stuff that they're not paying their fair share in New Hampshire, doesn't hold up to the facts that you are actually including right now in your tax base, either on a current or deferred basis, most, if not all, of this foreign source income. Just quickly on this one, you've all heard, you know, the issues on water's edge versus separate reporting versus worldwide. And there is only one state that partially taxes worldwide right now, and that's Alaska for oil and gas. As you can see from this map, all the blue states, I think somebody said the number 27, do water's edge. And again, it's been pointed out, just because nobody else does it doesn't mean that you shouldn't do it. But given that you're already taxing a lot of the, if not all of the income that's subject to contention here, to move to a whole other system that nobody else is doing. And I might add, you know, and there it would take a much longer discussion, but the comments that Dan Bucks and Darian made about the rest of the world is looking at things like worldwide apportionment. It's certainly true. The rest of the world is looking at ways of having global minimum taxes in Pillar 2 and in GILTI. The U.S. started this whole thing, that are different than the prior methods and that vary from arm's length. But that doesn't mean they're the same as worldwide. And just to give you an example, the European Union is more seriously than ever considering having formulary apportionment, but they're considering having it for a water's edge for the European Union. They're not talking about doing worldwide. So again, even though there's lots of concepts and global taxation is shifting, doesn't mean that they're moving in the direction of what the states would do with worldwide combined reporting. And the other thing I should point out is that all of these measures that are being considered by the OECD or by the federal governments around the world in terms of having global minimum taxes, and I'd be glad to answer questions, I'm quite familiar with what they're proposing, all are being done at the national level. There's not a single subnational government other than the US and the world that's really approaching these, with a minor exception I mentioned in my slides of Korea. Taxes a little bit of foreign source income at the subnational level, but these issues are all being addressed because they're quite complex at the national level. And that's not because these countries don't have subnational governments. A lot of them don't, but about 20% of the OECD G20 nations have subnational income taxes, Germany, Canada, and so forth. They're not doing this at subnational level. So, you know, in my mind, there is a problem here in terms of modernizing the world's taxing system, income taxing system, to address the ability to, in the complexity of supply chains and global growth and global trade. But it's all at the national level. It's a subnational level. And there's a reason for that, because it's complicated, and because if in the U.S. and I can send you my article I wrote on this. If in the U.S. does it at the national level and the subnational level, we're going to be taxing arguably our multinationals more than other countries will, who are only just taxing it at the national levels. One other point I wanted to make out on GILTI is I talked about GILTI being 50% roughly. That's true, but in 2026 at the federal level, it's going to go up to, and New Hampshire would conform, would go up to 62.5%. So all of a sudden, 62.5% of the current income, or the current income less, return on investment, would be taxed federally and in New Hampshire without you doing anything. So again, this is not an issue that's being ignored by New Hampshire. Just a couple points on the administrative burden issue, and again, be glad to answer questions. But it's certainly true, and the other speakers, there's no denying that lots of states had worldwide for a number of years. So clearly, companies had to comply with it. States had to administer it. It's certainly true that some companies choose where they can because there's elective worldwide. They choose, obviously, probably when they have global losses or global profits that are less than their domestic ones, they choose worldwide and they go through the administrative headache of that. It's not true that it's just a $900 or $1,000 return. We've talked to lots of our members about how burdensome it is. And I'll just give you one example, and this is really pertinent to New Hampshire. It's certainly true that you tax GILTI and foreign dividends now, right? Subpart F. So you might say, well, wait a minute, you've already got all this global income in your tax base. Don't you already have all these complexities? And the answer is no. And the reason it's no is because GILTI and foreign dividends and subpart F, all of those figures have to be calculated for federal purposes. They're on the 5471 or some other return. So it's not that you don't have to come up with some adjustments and apportionment for those, but they're already on the federal return. If you go to worldwide, you do have to, and it's not like you have to file a return for your 100 subsidiaries around the world, but you do have to look at your worldwide book income. You do have to look at adjustments that have to be made, just like you make adjustments now for New Hampshire versus federal. You'd have to do the same thing for worldwide. It is harder to do because there's different accounting standards. You have different depreciation. You treat partnerships differently than most of the world does. So there are a number of adjustments that have to be made and make that a much more complicated. And again, not impossible, not something that companies couldn't do or states couldn't administer, but quite a bit more difficult and much more expensive than the current system where you're pulling in a lot of foreign source income based on numbers that are available or largely available for federal purposes. And the point of this slide is it's not just a problem for the companies, it's a problem for the department. You have to audit this stuff and you're a small state. And so you will have to, unless you want to just accept the numbers, come up with auditors who understand some of the differences that I was talking about and potentially understand differences between IFRS, and GAAP, which are international accounting rules and U.S. accounting rules, certainly differences you have in your tax base and deductions, and the way you treat flow-through entities for New Hampshire versus the rest of the world. And so, again, just like I did with worldwide combined reporting, I'm not suggesting at all that you can't do that. You certainly can. It's constitutional. It's not that people couldn't eventually comply with this, but it's way harder than your current system, where, as I pointed out, you're already taxing most, if not all, foreign source income. Final point I wanted to make was just to sum up some of the other points on the policy concerns. So, all things being equal compared to what you're doing now, and I'm not endorsing necessarily what you're doing now. I mean, most businesses would say you're taxing way more foreign source income than you should, but given that you are, the administrative complexity of switching to worldwide combined reporting instead of doing it the way you are, it is significant. There is, and you may or may not care about being a policy outlier, but if you did worldwide combined reporting, you would be the first state to do it, at least in the last 30 or 35 years. You'd be the only state to do it right now, other than Alaska for the oil and gas industry, and some other states on an elective basis. The federal government doesn't do it. There are some overlapping concepts with what's going on, and if you read about Pillar 1 and Pillar 2, it's extremely complicated what they're trying to do, but they are doing it at the national level, and they aren't going all the way to combined reporting. They have more minimum tax structures. If a low tax country's not taxing something, we're going to tax it up to 15%. But again, they're all based on either forcing the low tax country to raise their rates or get rid of some of their credits and incentives, or having the home country of the multinational tax the stuff. The tax burden I addressed before, I just have one of the stats there, but there's some worse ones in the sense of, if you think business should pay more in New Hampshire, which is, you don't have to be at the national averages or whatever, but, certainly I think that our annual study shows that because of your unique tax structure, business is paying, particularly at the state level, significantly more of all taxes than they do in most states. And that's appropriate from your perspective. But again, I don't think you have to add on to that by a new tax system that imposes even potentially more burden. And then the revenue estimate, the Department of Revenue could talk to this, but some of these numbers, like these suggestions that you would just get this, fantasy $177 million quoted by several of the speakers, they don't back away from the number, but, the number does not take into account, let alone critiques of, whether the underlying numbers are valid or not, or overstated to start with, but far more important, doesn't take into account what you're taxing. Darian brought something else up, which it doesn't take into account apportionment. It's not adding the foreign factors, which you really would have to add in. But even more important than that, it doesn't take account that New Hampshire is already taxing most, if not all, of this income. So that's the general presentation. I did want to make one point on, there was some conflation early on, and one of the speakers talking about foreign parented companies versus domestic. And all of these numbers, like the $170 million, $7 million, those aren't numbers about profit losses from foreign parented companies. Those are, U.S. parented companies. And the reason for that is because pretty much under the international regime right now, each country can tax, if it wanted to, on a worldwide basis, its own multinationals. They don't tax other countries' multinationals. So, I think it's a little bit of a red herring. There are certainly different rules for foreign parented companies, but that's not by any means the big issue here. The big issue is U.S. parented companies, and should you be imposing worldwide combined reporting on them? In addition, you could consider imposing it on foreign companies, which do have certain different rules, but that's, for me, that's sort of a side issue, and that's certainly not the issue that's being addressed with the estimates on profit shifting. That has nothing to do with foreign parented companies. So let me stop there. I would love to, on any of these topics, and, if anybody has any questions on what's going on with Pillar 1 or Pillar 2 and why that's different than worldwide combined reporting, I'd be glad to answer that. There's a lot there, but I do think that this issue has to be considered not whether any state should do it. I don't think they should, but certainly the issue here is whether New Hampshire should do worldwide combined reporting, and in my mind, that's not even a close call.
Thank you very much. Okay, questions? Okay, yes, I acknowledge that.
Thank you for your presentation. I appreciate it, but I've got a couple, 3, 4 questions here. You talked about the percent of taxation in New Hampshire. Can you provide us with the data source of that?
Yeah, so it's from this report, which is based on federal and state specific data. So Ernst & Young has an economic policy unit, and to my knowledge, nobody's ever criticized their underlying numbers. I mean, you might say, well, this is not relevant, or, there's an explanation for it, but it's all based on federal and state data.
If you could provide that to.
Yeah, no, I will send, tonight, I'll just send the whole report, and we do it once a year. So if you went to our website, you could see the information for the last 20 years. It's very informative. I mean, our discussion aside.
No, I just went to your website, and it's not, you have to log in and all that stuff.
Well, no, this information is available for the public. So if you just go to there's some things you have to log in for, but all of our studies are publicly available.
I do that at home from PC. You also talked about the fact that they're subnational. In the United States, it's generally called federalism. Other places, Canada has with the different provinces, it's a little slightly different. And Germany is based on their kingdom, so it's slightly different. Same thing for Australia with the different states they have down there. But so the question is, would worldwide combined reporting contribute to the concept of federalism in the United States under the 10th Amendment, reserving rights, or would it be detrimental to federalism in a philosophical sense and yes or no is a good enough answer.
I don't know if I can answer yes or no. I mean, it's a constitutionally sanctioned by the Supreme Court methodology. Whether it contributes or not is in the eye of the beholder.
Okay, that's kind of the answer I was expecting and hoping for, actually. If I might, Mr. Chair, a couple more.
Yes, go ahead.
You also mentioned, following up on that, subnational taxation. If a subnational entity goes to combined reporting and a subnational entity or even a nation over there, wherever over there is, goes to combined reporting, and yet they're basing their taxation on the same corpus. So we're getting our cut, they're getting their cut on the same dollar. So isn't this double, triple, quadruple?
Potentially, absolutely. And the Supreme Court kind of said, if you read Container Barkley, that there could be some double or triple taxation, but that's not the point. The point is, if everybody did this method, it would work out okay. And I'll give you a great example of that. One of the objections the business community has to GILTI really is that for federal purposes, you calculate a GILTI amount, and then you deduct foreign tax credits. You deduct what was paid abroad, right? You're not trying to double tax something. For state purposes, you don't do that because we don't observe foreign tax credits. So you bring in GILTI and then you apportion it, and that may or may not be a rough justice. So there's a lot of that going on, and there's a lot of risk of that coming up with global tax reform.
Yeah, there's a whole bunch of questions that just came to mind on that, which will.
We may come back to you.
Well, no, I got one more question on that.
okay,
Which
go
was
ahead.
the item we talked about earlier. And just from your perspective, because I've asked this question of other individuals, other presenters as well. The data on revenue, pre-19, or 1981, 1986 versus after 1986. It's my understanding that the business revenue, not just from New Hampshire, but globally, has increased with the going away from a combined reporting versus the percentage or the basis that was there at that time. Do you have any data on that?
I don't. I mean, I haven't seen a study that's looked conclusively at that. Not that it doesn't exist, but I would mention one thing. You brought up the question to several other speakers. On what about if you have losses? And there's an interesting question because it's a valid, I mean, I think overall you're going to have more gains than losses. So, but, the losses are reflected and you could actually lose money for different companies with combined reporting. But, with worldwide combined reporting, what's interesting though is GILTI and foreign dividends are only positive numbers. You don't, nor does the federal government allow foreign losses to come into the calculation. They may reduce a given year's GILTI, but you don't get a negative number that carries over. So the way you're doing it right now is only pulling in positive revenue. You're not pulling in losses from abroad, given your current system of taxing foreign source income.
Yeah, but at the same time, that positive number can be reduced by the expenses.
It can be reduced by losses. The foreign dividend number can't because that's only a positive number. It can be reduced in a given year, but let's say a company has a $100 million loss. That it's a current year number. That gets lost. That doesn't come over to New Hampshire.
Wow.
You're essentially saying there's no carry forward.
There's no carry forward on GILTI. It doesn't work that way. Yeah. So that,
Well, let's do the shipbuilding because like if we're coming up with a new, let's say, that company's coming up with a new shipbuilding design in Norway at one of their yards. But they need money because Norway's not financing it because it's going to be a commercial ship or something like that. Super fantastic green ship. They're going to need money from somewhere to finance that, so they're going to take it from everywhere they can in order to do that. That's just shifting profits from here to there to pay for something else.
Yeah, and I mean,
And that would be over a period of time.
Yeah, I mean, this is it's a little esoteric, but one of the biggest differences between Pillar 2 and GILTI is Pillar 2 is a country by country calculation, so they don't take into account losses in other countries. GILTI is a net calculation, but there isn't carryover losses, as you said. So, it's not, it doesn't mean you'll get more or less out of worldwide combined reporting, but it is a difference. You're not pulling in sort of net losses from foreign operations right now into your tax system.
Thank you for providing more questions.
My pleasure.
One question I'd like to ask. So we have some states apparently that offer an option. And I have to presume that that option is always evaluated in the sense of which methodology results in the lower tax bill. So based on your experience, what's the rationale of those states that say you can, if it works better for you, file unitary combined reporting, but you can also limit it at the water's edge if you want?
Well,
What's the thinking there?
Yeah, I mean, one qualification on what you just said is most of the states that allow the option, I think it's like 10 or 8 or something, require you to do it for a number of years. So it's not like you can go back and forth. So, it does give them, maybe they think it's fair. I mean, if you have on a continuous basis less profitable or losing operations abroad than you do in your U.S., it's might be perceived as a fair way of income averaging, but a lot of it binds you for it for a number of years. So I guess I can't answer specifically your question. Some of it may just be a carryover. Those are mostly the same states that had it before, and they either left it as the default, like California, and then you can opt into the water's edge. That's what happened with a lot of them. It just, they didn't get rid of it from their system. They just gave you the water's edge option.
Mm-hmm. That one leaves me curious to dig further, but thank you.
Yeah. Yes.
I also wanted to clarify. So I've seen the state by state report in the past. It's very helpful. And I understand the basis for your indication that New Hampshire raises 47.9% of its state and local taxes through the business taxes, compared to 43.6, which is not such a drastic difference.
Well, that's
but I
because your
heard
property.
you to say something else, and I'm not sure I picked
Yeah.
up on what you were. You mentioned something else about there being 62.7% of New Hampshire's revenue from business.
Yeah. So we break
versus
that
37
yes.
average, and I didn't get the
Yeah,
distinction.
no, it's a great question. So, and there's just a separate chart in there that you'll see, but we break it down. The first statistics you mentioned was what portion of all state and local. Local includes property tax, which changes that number significantly. But the other stat, we break it down, what percent of state taxes come from business, what percentage of local taxes come from businesses.
So inclusion or exclusion of the local real
local,
property
yeah.
tax is the difference.
Yeah, yeah.
Got it.
I mean,
That's what I suspected.
absolutely. And since you may affect property tax policy, but you're more concerned with raising state taxes, that's why I brought up that number was 62% versus like 37. I mean, you really raise a lot from business. And I'm not saying it's good or bad. It's just the way your tax policies work out.
So a further question, just to clarify on the foreign dividend tax. As I understand, and I'm not sure if it was tied this closely, but you said that at the time that New Hampshire repealed the combined unitary reporting, that's when we implemented the tax on foreign dividends. Were they tied?
Yeah, I mean, I don't know if before 1981, you probably had separate accounting. So yeah, at the time it happened, and to New Hampshire's great credit at the time, the great Stan Arnold, remember your great commissioner who was, beloved on both the private and the public side of it. But he was one of the only 2 or 3 states that as a legislature, you decided to tax 100% of foreign dividends, which was what the federal government had been doing for like 90 years. But you also then brought in all the factors. You did it fairly. You said, okay, we're going to tax 100% of global income. When that income comes in, we're going to allow those foreign factors to come in. Professor Hellerstein has written extensively on that is the fair way, bring in the income, bring in the factors. Most states didn't and continue not to do that. They don't bring in all the factors. So actually, when you did it, you thought it through better than most states and allowed you to bring in the income and bring in the factors. So.
And so further to clarify, when we say foreign dividends,
Yeah.
I'm not familiar with that provision in the tax code. We're talking about, it may include dividends received by individual shareholders who are private individuals, but we're talking primarily about dividending between affiliated corporate entities.
Yeah, so just to clarify, so just to give you an example, individual taxes are much different, and so I'm not getting to that, and I know you don't have a personal income tax, but if you had 50 U.S. subsidiaries for a U.S. parented company and 50 foreign ones, foreign dividends are simply all of the income earned by those foreign subsidiaries. You don't tax it on a current basis. And that now you and the federal government taxes a big chunk of it under GILTI, but the rest of it you don't tax unless they send it back to the parent.
So it's getting rolled up to the parent.
Dividended back. So it means it eventually gets taxed. There was a big problem internationally, which is one of the reasons the U.S. changed it, because $3 trillion was sitting there, because what was the incentive to bring it back? All I was pointing out was, for the handful of states that do still tax dividends, probably much less of a disincentive to bring it back now. So you're probably getting more money from it because you're not getting federally taxed on it anymore, because the federal government got rid of that tax, phased it out.
No longer a reason to just park it in a foreign country.
Correct. And so that, even though that might not have brought you in as much money between 86 and 2017, it's probably different now.
Other questions? Yes, sir.
Of course you don't.
All right.
Thank you, Representative Schamberg, for having questions.
Mr. Frieden and I have crossed paths before in here back in 2020, February, and
I hope it was amicable.
yeah, well, I pulled out some papers that I had from back then, but my new questions now.
Good.
You mentioned that New Hampshire businesses, multinationals, are really paying more than their fair share, but are there businesses in New Hampshire that profit shift to reduce liability here in this state?
Well, my point was, and I don't know if I said paying more than fair share, I was just comparing you to other states. So it's, somebody can decide or not. But the point I was making was that certainly profit shifting exists, as you heard from other speakers. Certainly the whole world has recognized it. There's a big debate as to how much, but that doesn't mean it doesn't exist. But the solution to profit shifting being proposed is to bring the foreign source income into the base. One way to do that is being proposed, which is, we think overly complicated and different than anyone else does, which is worldwide combined reporting. Another way to bring it in, whether it's profit shifting or not, but when you bring in GILTI, when you bring in foreign dividends, you're bringing in the profit shifted foreign income, the non-profit shifting, you're bringing in all the global income or most of it. And so it's sort of one and the same. If you were to say to me that there's there's 5 multinationals in New Hampshire and 3 of them are profit shifting and 2 of them aren't. When you tax their foreign source income, you don't really distinguish. GILTI distinguishes a little. Foreign dividends doesn't distinguish at all, right? It's just bringing in all of the money earned abroad eventually, and that's whether it was low taxed, high tax, whatever. You're not really making a distinction between those. I mean, GILTI tries to make a distinction very imperfectly. Foreign dividends doesn't make a distinction, right? So does it answer your question? Yeah.
Fine answer. I had another question here. Do you have, historically, do you remember, because you and I were both young, way back in this time period.
In 2020.
Well, I'm going back to 1984 right now.
Ooh.
Why was it, do you have any idea why it was so important in 1984 or 85 or 86 to change from our worldwide combined reporting / unitary method that we had then to go to water's edge? Any insight that you can give us on that?
Well, I do remember in 84 and 86, the Celtics won the title, right? Those are important years for Larry Bird, as well as 81, and I could give you all their numbers too. But no, I mean, there's just been a lot written on that topic. I mean, clearly, there was a Supreme Court decision that said you could do it. And then there was both some foreign countries, many, it wasn't just Japan or UK that were upset with that. And then there was a Reagan presidency who, through the Secretary Reagan, had a commission, and the commission came up with conclusions that said you shouldn't do water's edge, and even backed it up a little bit by saying that if you don't voluntarily move away, we'll consider federal legislation to do it. So that was sort of, it's been well written about that. That was the sequence of events that occurred at that time.
Well, your comment that they would have done federal legislation, I think Professor Hellerstein might disagree with that New Hampshire can set its own tax policies on various things.
Well, the states have right, but the federal government has. I'm not saying they would have or should have, but they have the right under the Commerce Clause, not the negative Commerce Clause, but the
Right.
positive Commerce Clause, to decide that something is a violation of commerce. And they could decide that was a violation of commerce to do it, but they didn't. But they could have.
Can Professor Hellerstein make a comment? He's back. He's been itching. I see him going like this.
Yes.
I can't resist it. It's neither good nor bad, but I just think there's something when if tomorrow New Hampshire decides to have an income tax with one factor, two factors, three factors, that's up to New Hampshire. And the only test as to whether or not, I don't say I like this, I'm just telling you this is ought to be on the table, is whether it is internally consistent. In other words, the test for the validity of a new formula, is if every state did what New Hampshire's doing, not that they do, would it result in double taxation? If the answer is no, it's okay. By contrast, when you think about it, and this is terrible, I think, not terrible, it's not good. I mean, for many years, Iowa, every state had three factors. It makes sense. What produces income, right? Capital, they told us way back then, and labor, and sales. That's okay, market. And then Iowa decided, well, we think it's just sales. How can you do that? You don't count capital, you don't count labor. And the U.S. Supreme Court said, it's okay. They basically said there still is the question as to whether or not Iowa may have taxed too much. But I'm just saying when you evaluate this, there's, in effect, the general constitutional test is just whether, if everybody else did it, would it hurt cross-border taxation? If the answer is no, then that means the basic approach is okay. Then you still have what keeps us in business, people build by that. It turns out that when you look at the actual facts of the case, when Iowa assigns all of the income of General Motors just on the number of the cars that were purchased in Iowa, that's disproportionate. So I just think that ought to be something that you consider when you're thinking about this issue, that what may be bad in application may not be bad in terms of anybody thinking about, is this okay in principle?
Is there anything that you'd like to add?
Well,
Mr.
no,
Frieden?
just, my first part of my discussion or dialogue was just, this is constitutional. That's different from whether it's good tax policy for New Hampshire. And that's kind of what I focused on. I think more than most of the speakers who were kind of more generically talking why about this is good tax policy. I mean, I think you have to look at it, not just is this, generically good tax policy for all states, but is it good tax policy for New Hampshire, given that you, at least in my mind, have already largely, maybe more than you should have, but largely addressed this issue already in terms of foreign source income being in your income tax base.
I would just add a further comment on the constitutional issues. So the question of the Commerce Clause has been litigated in these cases, and the Supreme Court has blessed what the states were doing, given them latitude, fair and reasonable. The thing that has never really cropped up, but seemed threatening at various junctures, was whether the federal Congress would act. Because if the federal Congress did take the step of regulating this area and dictating a particular system, that would probably constitute preemption. And what I recall of the period of 1983 to 86 is that Congress was being urged to act and never took the bait. So that just further amplifies that it's a matter of public policy. the states are free to do it, and Congress has resisted the temptation to tie our hands.
Yeah, and I mean, no part of my discussion did I suggest that Congress would step in now. I mean, the times have changed a lot. States could certainly do this. The question is it a good idea or not to do it? I think that's what we're all, and I think you've had a terrific discussion on that today.
Well, we have, and thank you.
I had the one more.
Oh,
comment.
one more, okay.
Come on.
We still have the DRA coming now.
Yeah. Yes, I know. When you were here, we talked, Jason Furman was the professor at practice of economic policy at Harvard Kennedy. He made a statement that in presentation to Congress, the corporate tax collections are very low in historical perspective and compared with other countries. This contributes to an overall low level of revenue. And I'm concerned, like with people like Mr. Collins over here, the private domestic company, that in this country we have no privilege class, either citizens or business arrangements. Do you feel that this bill as structured, it really opens up, in my feeling, to fairness and equality to all, everywhere, in New Hampshire business structures? Or if this bill fails in this commission, does it give continued power to a privileged class of businesses, multinationals, over our domestic businesses? Just a
I mean, I'm impressed you had notes from that. I'll be careful what I say to you in the future. 2020, whenever it was. No, I mean, I think, I'm looking at this from the purpose of this commission, which is determining whether New Hampshire should do this or not. I don't think everyone's looking to New Hampshire as the beacon of if they go this way or that way, it will change everything. So I can't answer your broader question, but I do think it's really important. And that was, if anything, that was my major point in my presentation with my first substantive slide, second slide in there, is that all that you're doing with Worldwide, and it's a lot, is suggesting that you can't determine how much is earned in New Hampshire unless you bring in the global income and the global factors of a company. That's all Worldwide does, right? You take away the fancy name, whereas with Water's Edge, you're just looking at all the income in the U.S. by the U.S. subsidiaries. And if you are doing that already, you're largely, it's not 100% match, but if you're largely doing that already in a different way by, with your taxation of GILTI, Subpart F, and foreign dividends, for me, that puts the whole question of profit shifting to the side. How much it is it in, because you're already addressing the issue in a different way. And so the choice in New Hampshire is, even though you're addressing it and bringing in more foreign source income than perhaps, and I mean it, certainly any jurisdiction in this country, the federal government, but perhaps the way even other countries are thinking about doing under Pillar 2, it's a little bit different, but arguably you're bringing in more foreign source income than they're even thinking of doing. Do you need to go some other methodology to do it? Now, it might be a different question. I'm sure we'll have different debates in lots of other states, but that's the debate in New Hampshire.
Okay, thank you. Second, one clarification. So therefore, it's fair to impute that you believe that if New Hampshire was to implement unitary combined reporting, then it would be appropriate at that time to do away with the taxation of foreign dividends and GILTI.
Well, you'd have to. I mean, not just appropriate; it would be double taxation if you didn't. Yeah, you'd have to deal away with them. And it's just like the U.S. has credits for to make sure they don't double tax stuff. But yeah, you couldn't do both. And my point, among other points, was to switch. Not only is more administratively complex, but there are consequences to do something that nobody else is doing, both, optics of it and the, the breadth of what you're trying to do, as well as the complexity. So I personally am saying you shouldn't go in that direction.
Exactly as I understood you then.
Thank you.
Thank you. Okay. So that brings us to our last presenters. We're calling forward Fred Coolbroth, Director of Audit Division at DRA, and Keen Wong, one of our members, who of course is Tax Policy Counsel at the DRA. And I think this has been a very balanced agenda, and I'm extremely pleased with the fact that we've had, robust proponents and opponents and good reasons. The question that I think we really want to focus on now with the DRA is, as a practical matter, if we assume that we actually enact this program, for example, on Representative Schamberg's HB 121, what would you be dealing with in terms of forms, filings, audits, enforcement, and the like? So take it away.
Sure. And as you said, this is Fred Coolbroth, Director of Audit, with my colleague King Wong.
Tax Policy Council, the DRA. But before we start, we just want to state that the DRA does not have a position on this.
We take the easy road out. And thanks everybody for bearing with us here. I know we're at like -2 minutes according to the agenda, so apologies for that. And I just want to say, as a student of tax and a self-professed tax nerd, this has just been a pleasure just speaking for myself, this has been a pleasure, I'm sure for Keen as well, just to hear all of these experts who are a lot smarter than me talk about these topics. Believe it or not, this is fun for me. It's why I'm in the world of tax. So this has been a pleasure, and I appreciate the Commission's time and giving us an opportunity to chat here. We can certainly talk through the practical implications for DRA here, but we could also get a little bit into the substance as well, but I think everyone did a really good job with that already, so we could sort of play that by ear and see what the Commission's appetite and what the time allows for. To your point, Chairman, as a practical matter, there would just be more of everything, I like to say. There certainly would be more demand placed onto our so-called front-end operations. So the division of our department that handles tax returns, there would just be more tax returns, both from the existing combined filing groups that would just have more entities in their group. There's just going to be more paper, but also potentially new taxpayers. So there'll just be a greater volume of tax returns to process. That is something the department can swallow and administer. So that's certainly not something that we couldn't administer. From an audit perspective, the demands would be greater. As I said, there would be more of everything, all of the much more in the way of documents. From a practical matter, the logistical strain would be significant. We'd be looking at additional expenses, particularly for travel. The method of auditing these types of taxpayers involves field work. So we have to go to their headquarters, or if not their headquarters, at least where we can reasonably expect a material amount of their documentation and their responsive folks to be. Normally under a water's edge method, or always under a water's edge method, that's somewhere within the United States. If we move to a worldwide methodology, the only way to enforce this is to go to where the documents and where the people are. So travel would involve going to Japan or China or India. That's going to bring with it, obviously, the increased cost and burden of travel. As some folks already elaborated on, there will be some language issues at play here because as folks have mentioned Ronald Reagan a couple of times, the thing we'll borrow from an audit perspective there is the whole credo of trust but verify. We're going to need to see source documentation from taxpayers. So that involves seeing what they have prepared in the original language. And, we're lucky to have Keen, who is smarter than me and speaks several languages, but that is a practical reality that we'd be looking at. We would need to draw down on foreign language expertise, either as part of hiring or outsourcing that function to some kind of service provider. And then, as folks have already mentioned, there are accounting and currency exchange rates and processing issues that we would just have to take into account as a part of that just increase the complexity of the audit process. So it is more complicated. I think if this is, or I know if this is something that the legislature decides to do, it just will be more of a burden on audit, or it would demand more resources from audit. To give you a current sense for what this looks like, we have several different teams in the audit division. The team that currently audits these types of taxpayers, the large multinationals that are filing on a water's edge basis right now, that we have about 14, or exactly 14 of those positions that are fortunately fully funded. Thank you all. Not including their manager, so we can kick that up to 15. Right now I'm at a vacancy of like a third. So I have 5 vacant positions right now, and that will go up to an additional vacant position for a total of 6 when one of our best auditors retires Friday. So it's an existing strain on our resources. As many of you know, this is a difficult hiring environment for employers, and I'm an employer in a sense. I go out into the market and I hire accountants and lawyers who go out into the world and audit these taxpayers, and it can be a challenge when these industries are also competing with us and hiring with much more competitive compensation packages.
Just to clarify,
Please.
so you're saying that you have 14 authorized billets, of
Yes.
which only 8 as of Friday will be occupied.
Correct. Yep. Yep. Yeah. So those are the that's the impact on the audit division, which I know folks were interested in hearing us talk about. How would the department absorb moving from Water's Edge to worldwide? So that's my take on it as the audit director. Keen, I don't know if you want to add anything further.
No, not at this point. No.
So then, unless there are questions on that, we could move into some of the substantive. Please.
I do have a question.
Sure.
And maybe others. So recruiting challenges are inherent already, even if the law doesn't change.
Totally, yes.
Resource requirements are going to increase. But what about the specific qualifications or background of a adequate candidate? Does that change?
That's a great
Does that become more challenging?
Yeah, that's a great question. Potentially, yes. So one of the we try to be flexible. These are all unclassified positions. These folks exist outside of the personnel rules and outside of the collective bargaining agreement and the union. That goes a long way in to help make us more competitive and allow us to conduct the work that we do. But to your point directly, yeah, we are going to have to, as I said, we're going to have to find a way to increase our breadth of knowledge, particularly with respect to languages and these other, frankly, exotic accounting and currency methodologies that we will need to somehow onboard that expertise, either through direct hiring or the utilization of service providers, which, as you all know better than me, brings its own challenges, and from my perspective, causes me some concerns with respect to confidentiality, respecting the confidentiality of the taxpayer's information and protecting the taxpayer, which they're entitled to under the law, and that we have to ensure that we're safeguarding their information.
Representative Ellery?
Yes, you had mentioned an exchange rate and just having a passing.
Sure.
It seems to me that if you're doing an audit, that's over a period of time. And yet an exchange rate is over a period of hours.
Correct.
Minutes.
Yeah, correct.
So how do you determine what a dollar's worth at any given time?
That's a great question, and we would need to bring that expertise on board. Presumably that would have to be hashed out under audit between the taxpayer and our auditors. So they're going to have their own. They're going to have to hire their own experts if they don't already have that expertise somewhere. So they'll get that expertise onboarded. We'll have our own people, and we'll have to hash it out to figure out what would be acceptable to both sides. And it might be the case that neither side agrees with the other, and that would just be yet another issue to litigate if it goes into litigation.
I think the phraseology in the legislature is a lawyer's employment bill. But
That's right.
the other question I have is you talked about language problems and translations or transliterations.
Yep.
Even English to English can be difficult.
Sure. Yep. Absolutely. But as I said, this would, if we're gonna enforce this, and if folks are expecting this legislation to perform a revenue raising function, there has to be a robust audit enforcement mechanism here, and that's going to require my auditors to know what they're seeing from source documentation. So they're going to have to read this stuff directly. They're going to have to be able to talk with someone to be able to gauge if this accountant or if this return preparer is a credible person or not, if what their gut says.
Thank you. And the only reason I brought that, I was reading some history last night, and this is near the time when the Gloucester Regiment was decimated in Korea, and the commander asked for help by saying he was a sticky situation. He was under the command of an American. He said, "Oh, it's just a sticky situation. Who cares?" He was being beat up.
Yeah.
And the Americans said, "Oh, no big deal."
Yeah. Absolutely. That's a great point. The language challenges and the failure for some of these concepts to be able to translate easily is going to be something we'll all have to wrestle with.
Thank you.
So while we're on audit, other questions relating to audit?
Well, yes.
Go.
It's your turn.
Thank you.
Yeah.
Since we're in the digital age.
Yes.
Not like I am most of the time in the pencil age. These subsidiaries that are located here, couldn't they, in nearly all cases, provide the necessary information to satisfy the audit information that you need here in the state versus, I realize you like to travel to London, okay? Wouldn't the DRA set up some kind of rules adopting, requiring the maintenance and availability for audit of taxpayer information relevant to this? Wouldn't it be able
Yes, that's a great question. So
combined here?
Yeah, that's a great question. So the ease of transmitting information has definitely got a lot easier. That's a great point. And you're right, we utilize that right now with secure file transfer applications and encrypted emails and all of that. So it's an excellent point, and we use that already, and that would have to be part of any audit in a worldwide environment. But there's something to be said, and I'm a big advocate of field work. Until Lindsay someday gets tired of me and fires me, which is probably tomorrow. But I'll always advocate for field work because I just think, as important as the digital tools are, and yeah, we can get volumes of information on a through a file transfer in a second, but you don't know what you don't know if you don't go and see their operations with your own eyes. Someone, I think it was Carl Friedman from COST, mentioned former Commissioner Stan Arnold, and Stan actually, I worked with Stan in his subsequent life in private practice. And he had a great anecdote that I've stolen from him and I keep alive because I love it. But the image I like to picture, or the image I like people to picture, is from the original Indiana Jones, where they kept the Ark of the Covenant in the warehouse at the end. I think it was the CIA or whomever. They've got their top men with the Ark of the Covenant in this massive warehouse, and it's buried in the back. So Stan, as some of you know, started as a field auditor, and he got sent out to a audit here, Water's Edge audit, but it was I won't say which country just to fully protect the identity of this taxpayer here, but it was foreign parented company, and so he's auditing them, and they've got him in the Ark of the Covenant warehouse, and they think they're really sticking it to him because, oh yeah, you can have all our documents. We're not going to make them available to you though. You have to come to them, and we're going to put you here. And long story short, what they didn't know was that Stan actually spoke their native language. He spoke the parent company's language, and so he had no problem rifling through their stuff, and he very quickly found a lot of damaging information in there. So there's no you just don't know what you don't know until you actually get out there, see their operations with your own eyes, and we're just going to need to do that just to see what passes muster. If we just get a bunch of information from a file transfer, that as a practical matter, that's how we'll get most of the stuff that we probably end up using. But until you get out there, in China or I'll shut up. Thank you.
I just want to add something to that as well. Even here currently in the for local U.S. audits, Water's Edge audits, there are some situations where the taxpayer says, no, we're not going to be transmitting those documents online or in a CD or anything like that. If you want to see those documents, you have to come to our office. So those situations have occurred before. And they have their own privacy policies, and so we just have to adhere to that.
I must follow up on that. You mean to tell me the private company can tell the New Hampshire DRA that they cannot have that information transmitted if the rules and legislation is set down that way?
So what happens under audit is we will ask a taxpayer to provide this information for us, and to your point, we can escalate the tactics that we use as necessary. We try not to do that just to preserve the working relationship between whether you're a mom and pop pizza shop or the biggest multinational in the world. Audit is not fun. You don't want to see Keen and Fred show up to your doorstep. We're nice enough guys, but it's not going to be pleasant for anybody. So if they resist but say, look, we're not going to send you this stuff, but you can come and see it, we'll accept that, and we'll go to their location and we'll see where the documents are, particularly if the records are old and haven't been digitized. If they don't, to your point, we do have tactics that we can subpoena them, we can force depositions. It can get nasty. So there are tools that we have, but we like to keep the process as collegial as possible for as long as possible before we resort.
Isn't it also true that in a field audit where you have access directly to source documents, you can make quick checks, random searches, et cetera, look for red flags, which is completely different than the kind of fishing expedition you'd have to go through to have them disclose exhaustively everything they've got.
That's a really good point.
It actually becomes a way of limiting the scope.
Yes, that's a really good point. I was just having this conversation with actually the auditor who's retiring, and the value of a narrowly tailored request to a taxpayer as opposed to just requesting every single thing they have, which for a pizza shop, fine, but for a multinational, we're talking trillions of pages here. That's not. How can we be efficient with everybody's time here?
Okay. If you don't have any objection, and I'm fine with this, I understand that Dan Bucks, who's still connected with us online,
Sure.
has a question narrowly focused on the audit topic.
Yes.
Well, Mr. Chairman, if I could, I guess I have a question that is after a comment, and I must say, I have a very high regard for the New Hampshire Department of Revenue Administration, and I have a special place in my heart for auditors who have to do very difficult work, and some of the most difficult work in tax administration. But I have always been somewhat puzzled by the assumption that Worldwide Unitary requires any extensive international travel. And and I'm not clear as to why that is the case. When the states practiced worldwide unitary in the 70s and 80s, it was at least for the states that I'm most acquainted with, the smaller states, and we have a in that sense, we're very much like New Hampshire. It was not necessary to travel to foreign lands to acquire the records. The corporations that had a connection with the state, such that they had nexus with the state, are operating in the United States, and they have international accounting firms with offices in the United States that handle their tax filings, and the records were typically available. And I must say that auditing continues today in the case of worldwide returns that are voluntarily filed. And for a long time after, for example, the state of Montana went to a water's edge election, the vast majority of taxpayers continued to file worldwide returns for 15 to 20 years. It was only in more recent years, when profit shifting became more popular, that corporations increasingly have chosen to file water's edge. But in my tenure as deputy director for from 1981, late 1981 to early 1988, and again in the 8 years from 2005 to 2013, and during my tenure with the Multi-State Tax Commission for 17 years, where we audited for states for worldwide returns. Again, even after Water's Edge, there was a substantial delay in companies switching to Water's Edge. We never had to send our auditors overseas to conduct these audits. We could always secure the information. The only audit that I recall that we had to send someone to London for, that was the only trip that was during my tenure in 2003 from 2005 to 2013 in Montana. The only trip that was taken was to London to look at the board of directors records to establish a unitary relationship under a Water's Edge return. So under a Water's Edge return, you may have a circumstance that would arise where you have some international travel, but that's very rare. But this was one rare instance where we had to look at board of directors minutes that were in London, and that was for a Water's Edge filing, not for a worldwide filing. So I am puzzled by this, because that was not necessary to do an adequate worldwide return. It was not necessary to travel overseas to do so with any kind of regularity. I would guarantee you those trips would be very noticeable if you were traveling overseas from Montana. There were a few trips into Canada next door, but that's like going to the next state when you're in Montana.
New Hampshire too.
Mile border with the Canadians and 3 provinces, but that was generally for small businesses in Canada that were doing business in the United States, and that's not really what we're talking about here. So I'm puzzled by that judgment, and I've heard that before, and I would be glad to talk with the department about the requirements, and also to put them in touch with actual auditors that have done worldwide audits before, and at a very high professional level, and people who've done this. So I say this, make these comments with some trepidation or regret to having to do that, because I have such a high regard for any tax auditor at the state level who does corporate auditing, and I have a great deal of respect for the Department of Revenue Administration in New Hampshire. But I guess we just respectively have a different perspective on this matter.
Okay, so thank you. I think that's helpful to have a counter view, skeptical view.
Absolutely.
You don't have to, I don't think there was actually a question to answer, but it's food for thought, and there may be a value in some further communication directly.
Happy to talk with Dan, regardless of what you all recommend to the legislature, regardless of what.
Very good. Okay, thank you, Mr. Bucks.
Good. Thank you.
All right. Yes, Representative Ullery.
I've got two things. One, you haven't done a global combined reporting activity, but you do guilty ones, right?
Yeah. So, is it? I mean, I think Carl Frieden from Cost did a nice job of taking us through how New Hampshire taxes, what folks have been calling. Oh, go ahead. Go ahead.
Yeah, I understand that. What I'm asking for is from your point of view, how would you do an audit on of a guilty claim?
Mm-hmm. So
Or
we.
a question, and I'm not talking about any specific taxpayer.
Yep.
But do I think it would benefit the commission if we were to see a cost
Yep.
analysis
Yep.
of doing that as to your practice
Yes.
and procedure for that? So is that something that the chair could ask for from DRA?
Cost analysis?
A cost analysis.
I'm not
Oh,
sure
sure.
exactly what shape that would take.
I
But,
can speak to that now. So, yeah, we audit guilty right now already, and it's relatively inexpensive to do because it's part of our existing audit program. Because, as folks have done a really nice job explaining already, we dovetail with the federal return. So we pick up the federal amounts, and what we're largely confirming at our level is just that they have properly reported it on the New Hampshire return. They've not, inadvertently taken the Massachusetts 95% deduction, or they've not omitted it completely from the return. We're making sure that it's there. We're making sure that they took the 50% deduction. If to your question is, how would we audit the substance of the guilty calculation? Yeah, it's, and I think as maybe someone mentioned already, the thing about guilty is it's not really an income class. I mean, we call it guilty income, but it's not like some other types of federal source income where there's something you can kind of grab onto. It's, royalties, or it's the payment of a foreign dividend. It's just once income of a controlled foreign corporation exceeds a certain threshold that's defined by the Internal Revenue Code, that amount is guilty. So it's pretty easy to audit.
Terrible acronym. But
Yes.
the point I was trying to get at is that your analysis of guilty is based upon existing required performance by the taxpayer.
Yes.
As opposed to something new that is not required.
Yes. You got it.
And the only reason I mention that is because in a prior life, I actually worked for Deloitte and Ernst & Young.
Gotcha.
And they required an on-site examination of all sorts of stuff.
Mm-hmm.
Hours in
Yep.
in registries of deeds, looking up property ownership and stuff.
Yep.
Just to make sure. And even currently, bankruptcy courts do the same thing.
Yes.
So I'm trying to understand where one is something that's already there and the other one isn't.
Yep.
And now we're talking about something else. So would it be, I don't even know if they can do it, but, or if it would be an extra charge or something, but could you outline as to how an audit of a combined reporting activity would take place from your point of view, and combine it with Mr. Buck's information as to how would you do it?
Mm-hmm.
How would it be done? And
so if I can try to clarify, are you suggesting that perhaps they would create an outline of the process they might follow?
yes, thank you for putting
Could-
words in my mouth.
could
I
you do
appreciate
that?
it.
Yeah, at a very high level, we can talk about process.
Right.
We can't talk about audit tactics.
No,
But
no,
yes,
no,
we could
no.
talk about
the steps
process.
you would follow through.
Yep.
Okay. Thank you for accepting that assignment. Okay, do we have other questions on the audit? So I think you have more. You have more for us, and feel free to go ahead now.
I'm sorry, I'm taking notes here. I apologize.
We'll let you,
Can you repeat that question?
I believe you had more substance you wanted to go through beyond the audit question, right?
Oh, yes, to the extent it's
I
helpful.
just want
for
you to be able to
folks.
resume.
Yeah, yep. To the extent it's helpful for folks, we can talk a bit about that, and maybe just to get, maybe it's appropriate just to really quickly go through and say at a very high level, just maybe to bring it all together, because a lot of folks have talked about how we taxed in the past, what the current system looks like, and what we would potentially be moving towards. So maybe it's just really helpful to, at a very high level, just to bring it all back together. And I was going to talk more about this, but again, Mr. Frieden from Cost took the wind out of my sails and said a lot of this already. So I'm not going to get super granular in the interest of time and to be respectful for everybody. But just really quickly to summarize. So the business profits tax was adopted in 1970, and we taxed on a separate company basis, as folks have talked about. There was no combined reporting. And it's my understanding, and if we had Peter Gar still here, he might remember otherwise, but my understanding is that we have consistently included foreign dividends in the tax base since we were requiring separate company filing. Then, as folks went through in a lot of detail, I'm not going to beat a dead horse here, New Hampshire moved to worldwide combined filing in 1981. As Peter Gar explained, there was inconsistent application of it at the time due to department policy. As he said, it was the commissioner's policy. I wasn't there, but it is true that the department was not requiring worldwide combination of foreign parented companies. And as Mr. Gar and others have said, it was because of the perceived litigation risk. Essentially, I think the determination was we don't want to have a bunch of income or a bunch of tax paid in that we'll just have to refund out if this litigation goes south. So there was, whatever the reason, whether that's true or not, there was a department policy not to enforce it, inconsistent application, and then in 1986 we moved to New Hampshire moved to Water's Edge combined reporting, which, as folks have said, we've been there ever since. Eventually moving from 3-factor apportionment to just sales, not super relevant for what we're talking about today. And then, as other folks have mentioned, we do include income in the tax base that folks are considering foreign source income. This is all income that either right now or at least in the past has been treated as income includable in the domestic base for federal income tax purposes. So this is consistent with traditional income tax concepts. As folks said, foreign dividends, and the simplest way to, it's pretty, I think it's a pretty simple concept when you break it all down. When you've got a company here domestically, somewhere in the United States, and they receive a dividend from one of their subsidiaries anywhere else in the country, that comes into the tax base and we tax it. It does get, and again, that has been the case in my belief since the enactment of the business profits tax. It does get preferential apportionment, so it gets better apportionment. Those foreign dividends get taxpayer favorable apportionment compared to any other source of income. They essentially get to use the apportionment factors of the dividend payer. They get to use the factors of that foreign affiliate that's paying the dividend to essentially put those factors into the denominator of the apportionment fraction. So you got the amount that was paid, you have to apportion it by a fraction, you multiply it by a fraction. The denominator gets bigger, so the resulting apportionment is smaller because it takes into consideration those foreign attributes when we're apportioning that. So it gets favorable apportionment. And as far as why New Hampshire still does this as opposed to not, again, we don't take any positions on what you folks should be doing or not. the rationale that you all faced when the United States at the federal level was or had just passed the Tax Cuts and Jobs Act in 2018, when the federal income, the Federal Internal Revenue Code was reformed, there was a decision for New Hampshire to make. Do we want to conform to what folks at the time called this deemed repatriation? In other words, and I forget if it was Carl or whomever, Professor Hellerstein, but at the federal level, the Congress, the IRS have retreated from the worldwide base to the territorial base. And as part of that, as Carl said, they would no longer be taxing foreign dividends. The idea being to incentivize to incentivize those companies to bring the cash back to America. But to reduce the bleeding, there would be a one-time deemed repatriation event where the Congress and the IRS are going to say, okay, sure, we know you're not actually paying a foreign dividend. We know that cash is not, it's not moving out of Ireland or the Caymans or wherever it is, China. It's still there, but we're going to treat that cash as having moved here, and we're going to tax it this one time. So New Hampshire was faced with a policy decision there. Do we want to conform to that and glom onto that big pot of money, or do we want to keep getting our steady kind of annuity every year of a little bit of foreign dividends every year like we've always got? One or the other. And I think, and I cannot speak for all of you, this was a legislative decision. I think the rationale was that from a budget perspective, it's harder to manage the general fund with a one-time enormous, cash payment as opposed to a steady, much, much, much smaller annuity over time. And so I think it was just perceived to be a steady revenue source over time. So that's the reason why New Hampshire did it differently there. It's not that we sort of made up this concept that doesn't exist. We just kept what we had because we foregoed. We went without the deemed repatriation and just said, we'll get it all as it comes back slowly. And then, as folks have already talked about, we get subpart F, we get guilty. So I'm not going to, you did a much better job summarizing it than I can. And in the interest of time, I'm not going to say any more about that. So I just thought I would briefly mention all of that. And probably the only other thing that's worth getting at, worth mentioning, because there has been so much talk about profit shifting and abuses and all of that. I guess the only other thing I would put in front of folks is the DRA in particular, but New Hampshire generally, and through the arm of the DRA, through us as your agents, we do have a few other tools that we can use to combat abuses. We have these theories called substance over form. We have this theory called economic substance, where the substance of what's going on is gonna actually govern what matters. Although the burden is against us in those situations. So normally the taxpayer bears the burden under audit. If the department wants to assert these theories, we have the burden to prove that no, it's in fact this is the substance of what's happening, not the form. So that's the only other thing I think I would put in front of folks that I didn't hear mentioned. And then there are a few other equitable apportionment theories. If we believe that the taxpayers statutorily allowed apportionment somehow doesn't fairly and appropriately reflect their activity here in New Hampshire, we can change it to be completely outside of what the statutes require. But again, we bear the burden to show that whatever we've come up with is the appropriate methodology. And you can bet they're gonna dispute that and sue us because we're going completely outside of the statute and we bear the burden there. So just some things to consider.
Okay, very good. Yes, Representative Lowry.
The question I've been asking regarding pre and post, not including the 2018 situation, the percentage of the taxable revenue received by the state from business taxes 1981 to 1986 versus after the change that took place in 86. Is that something that DRA can come up with? Is it available or?
I
Oh,
don't
I
think
love
so.
that expression.
Yeah, Keen would know better than me. So just, I was in kindergarten, but I'll pass this over to Keen.
I wasn't.
Regarding that, I'm not really sure if we do have records that go so far back, and even so, were there any calculations that was prepared? Because there are two ways of getting that information. One is if we have the raw data back in '86 and after, and then we'll calculate a fiscal analysis on that. The other approach is if calculations were already done back then, and we would just pick up that information and disclose that. So I personally don't know that answer, but I can definitely look back to see if we have any kind of information in our archives or something like that.
We would very much appreciate you investigating whether there is information that can be found. Okay. Yes.
I know I've asked before, but there's no way really to the premise is that if New Hampshire moved to worldwide reporting, that the transfer stuff, the income would come back in theory, though we don't know the numbers because we have the guilty income. You don't have enough information to actually even quantify or speculate how those numbers might come out.
No, we tried to calculate that, and one of the few reasons is because guilty is part of the federal return, and it's flowing through into the to the New Hampshire return. We don't parse out data that's on the federal return specifically on our system, so we just pick up the flow through that's directly from line 28 right into the federal return to the New Hampshire return. We might be able to somehow back into that number, but our system currently do not have that that mapped out at this point. And if we were to do that, that would not be like a next day turnaround kind of thing. We may not the returns that have already been submitted, we won't be able to get that data. It will have to be a going forward basis.
And presumably that would require some changes to how our system works.
So I think you did a very effective job at running through some of what the audit challenges might be. If we stipulate for the moment that you've done an audit and you've made an assessment, and the taxpayer is challenging your conclusion, what, if any, particularly unusual hurdles are you likely to find in the enforcement action or in the potential for litigation? Or do you think it's just business as usual and no different?
That's a great question. I think the short answer is we do expect that to be relatively business as usual. Presumably, if taxpayers have very little in the way of people and property here, some of our more aggressive incentives for getting compliance won't work. We can't lean them up, for example, if they don't have a lot here. So there could be some enforcement challenges there. I think our expectation is for most folks it would be relatively similar.
Mm-hmm. Okay. Very good. Well, thank you very much, DRA. Thank you to everybody who's participated today. I see that Mr. Pisetsky has still monitored this. We have all the way back to Mr. Opal and comrades. You've stayed with us. And I don't see if Professor Hillerstein is still there, but Mr. Frieden, Ms. Beeson, thank you very much. This has been a marathon. I have to say that when we had our organization meeting in August, we thought we would do this over 2 sessions. I think it's been wonderfully efficient. So as long as we've got the stamina, this is a good way to do it. If I can just take a couple of minutes I want to make sure that everybody knows we have 2 more meetings of the commission that have been properly noticed and are on the House calendar. 10 a.m. on Monday, October 2nd, and then again 10 a.m. on October 17th. It's hard to forecast exactly how things will flow, but what I'm envisioning is that when we meet next Monday, the members of the commission will air everything that we've heard, get everything onto the table, ask each other questions, determine whether there's information that we need to run down, and how we're going to get it, who we're going to look to. Keen, of course, will be part of that discussion as a member, and Mr. Coolbroth, I would strongly encourage you to be present in the event of questions that might arise during that. Also, I was asked earlier, and we agreed we're going to arrange to live stream. So again, the audience for this discussion is varied. It includes people who aren't even in New Hampshire. Anybody who participated today can therefore monitor the discussion and see whether we've mangled the point you've made. And I would also say that, of course, Representative Schamberg's bill HB 121 has been retained in the Ways and Means Committee, and it's part of the plan for the Ways and Means to deliberate on that before our reporting deadline of November 17th. So I'm very hopeful that we know what the issues are and more or less what direction we're going by the time we finish on October 2nd. It's possible that we'll be far enough along that we actually work on some drafts of the report and might have that in front of us on October 17th. But in any event, I would expect that on October 17th, we would nail down the direction and scope of the commission's report. And I would just add that we don't yet know whether we'll have a unified voice or a divided voice, but our process allows for a majority and a minority report. And I'm hoping that we're going to be able to get those together a week or two in advance of our November 1st deadline so that the Ways and Means Committee can do something with our report. Okay. So with that, any other questions? Well, thank you for the remarkable level of cooperation all around.
Thank you.
Meeting adjourned.